Poverty is defined as a condition in which individuals or households lack the financial resources necessary to meet basic standards of living. It involves insufficient income, limited access to essential goods and services, and reduced opportunities for economic participation. Economists and policymakers work across diverse settings, including government agencies, research institutions, international development organizations, and non-profit sectors. Some focus on generating new knowledge through empirical research, while others apply that knowledge in policy design and program implementation. In all cases, systematic measurement provides the foundation for objective assessment of economic deprivation. Everyday reasoning often fails to accurately assess the causes and persistence of poverty. A common example is the fundamental attribution error, the tendency to attribute poverty to individual characteristics such as laziness or poor decision-making rather than to structural economic conditions. This illustrates the importance of economic analysis, encountering intuitive but misleading explanations. Economics examines poverty at multiple levels of explanation. Market-level perspectives emphasize supply and demand, prices, and resource allocation. Institutional perspectives focus on property rights, legal frameworks, and governance structures. Historical and structural perspectives consider the legacy of past policies, discrimination, and power distributions. The same pattern of poverty can be explained at each of these levels, and comprehensive understanding often requires integrating them. Historically, poverty measurement grew out of concerns about subsistence and social welfare. Early approaches sought to identify minimum income thresholds necessary for survival. British social reformer Charles Booth conducted pioneering surveys of London poverty in the late 19th century, documenting the proportion of the population living below subsistence. In the United States, Molly Orshansky developed the official poverty measure in 1963 based on the cost of a minimum food budget multiplied by 3 to account for other necessities. This approach, with modifications, continues to define the official US poverty line. Contemporary approaches have expanded beyond income-based measures to incorporate multiple dimensions of deprivation. Economists distinguish between absolute poverty and relative poverty. Absolute poverty refers to deprivation below a fixed threshold of resources necessary for basic survival, regardless of the living standards of others in society. The World Bank defines extreme absolute poverty as living on less than $2.15 per day, measured in purchasing power parity-adjusted dollars. Relative poverty refers to deprivation relative to the typical standard of living in a given society. A household may have sufficient resources for survival, but still experience poverty if its income falls substantially below the societal median. The distinction matters because absolute poverty focuses on subsistence needs, while relative poverty captures social exclusion and inequality. Poverty measurement encompasses 3 primary methodologies. Income-based measures assess whether household income falls below a defined threshold, typically set as a percentage of median income, or as a fixed dollar amount adjusted for household size. The US official poverty measure uses absolute thresholds that vary by family composition, with adjustments for inflation. Consumption-based measures assess actual expenditures on goods and services rather than reported income. This approach can provide more accurate assessment because consumption may be smoother than income, which fluctuates, and because some households underreport income. Multidimensional poverty indices combine multiple indicators of deprivation across domains such as health, education, and living standards. The United Nations Development Programme employs a multidimensional poverty index that identifies households as poor if they experience deprivation in at least 1/3 of weighted indicators across 10 dimensions. The measurement of poverty involves several technical concepts. The poverty line or poverty threshold refers to the minimum level of income or consumption deemed adequate to meet basic needs. The poverty rate or poverty headcount refers to the percentage of the population living below the poverty line. The poverty gap measures the average distance below the poverty line for those in poverty, expressed as a percentage of the poverty line. This metric captures the depth of poverty rather than merely its incidence. The squared poverty gap gives greater weight to those furthest below the poverty line, capturing severity and inequality among the poor. Global poverty statistics reveal both progress and persistent challenges. According to World Bank estimates, approximately 700 million people, roughly 9% of the global population, lived in extreme poverty as of recent measurements, subsisting on less than $2.15 per day. This represents substantial decline from over 40% in the early 1980s, driven largely by economic growth in China and India. However, progress has been uneven across regions. Sub-Saharan Africa contains the highest concentration of extreme poverty, with rates exceeding 35% in some countries. In the United States, the official poverty rate fluctuates between 11 and 15%, affecting approximately 37 million people. Poverty rates are higher among children, single-parent households, racial and ethnic minorities, and individuals with disabilities. Poverty measurement has evolved to recognize that deprivation extends beyond monetary income. Economist Amartya Sen developed the capability approach, arguing that poverty should be understood as deprivation of basic capabilities rather than merely low income. Capabilities refer to the substantive freedoms individuals have to achieve valued functionings, such as being adequately nourished, avoiding premature mortality, and participating in community life. This framework emphasizes that income is merely instrumental to achieving capabilities, and that individuals may convert income into capabilities with varying efficiency depending on personal characteristics, social context, and environmental factors. A disabled person may require more resources than a non-disabled person to achieve the same level of mobility and participation. The distinction between income poverty and multidimensional poverty captures different aspects of deprivation. Income poverty focuses exclusively on financial resources, enabling straightforward measurement and comparison across populations. Multidimensional poverty recognizes that well-being depends on access to education, healthcare, housing, and other non-monetary dimensions. Research demonstrates that income poverty and multidimensional poverty do not perfectly overlap. Some households with income above the poverty line experience deprivation in health or education, while some households below the income threshold may have access to public services that meet basic needs. Poverty rates vary substantially by demographic characteristics and geographic location. In most countries, children experience poverty at higher rates than adults because they live in households with lower per capita resources. Single-parent households face elevated poverty risk due to lower earning capacity and higher childcare costs. Elderly poverty rates have declined in many developed countries due to pension systems, though older adults without retirement savings remain vulnerable. Racial and ethnic disparities in poverty rates reflect historical discrimination, educational gaps, and labor market segmentation. In the United States, poverty rates among Black and Hispanic populations are approximately twice those of white populations. Measurement debates continue to shape policy and research. Critics of absolute poverty measures argue that fixed thresholds fail to adjust for rising societal living standards and become increasingly disconnected from actual deprivation. Critics of relative poverty measures argue that they confound poverty with inequality, such that poverty cannot be eliminated through economic growth alone. The choice between absolute and relative measures has implications for policy evaluation. Under absolute measures, economic growth that raises all incomes proportionally reduces poverty. Under relative measures, such growth may leave poverty unchanged if inequality persists. The poverty line itself is subject to methodological choices. Threshold levels must account for household size and composition, recognizing that larger households require more resources but also benefit from economies of scale in consumption. Geographic adjustment accounts for cost of living differences across regions, though such adjustments are controversial because they may perpetuate regional inequality. Some analysts advocate for supplemental poverty measures that include the value of in-kind transfers such as food assistance and housing subsidies, as well as necessary expenses such as childcare and medical costs. The US Supplemental Poverty Measure incorporates these factors and generally shows higher poverty rates than the official measure, particularly for working families with children. International poverty comparisons require adjustment for purchasing power parity, which accounts for differences in price levels across countries. A dollar of income purchases different quantities of goods depending on the local cost of living. PPP adjustment enables meaningful comparison of living standards by expressing income in terms of a common basket of goods and services. However, PPP calculations themselves involve methodological choices about which goods to include and how to weight them, and may not fully capture quality differences in goods across countries. Poverty persistence refers to the duration of poverty spells and the likelihood of re-entry into poverty after exiting. Transient poverty describes short-term income fluctuations that temporarily push households below the poverty line. Chronic poverty describes long-term or permanent deprivation lasting years or even across generations. Research shows that a substantial fraction of the population experiences poverty at some point, but most poverty spells are relatively short, lasting less than 1 year. However, a smaller fraction experiences chronic poverty, and these households account for a disproportionate share of aggregate time spent in poverty. Understanding poverty persistence is central to policy design because transient poverty may require different interventions than chronic poverty. Poverty measurement also involves defining the unit of analysis. Individual poverty measures assess whether each person lives in a household with resources below the poverty line. Household poverty measures assess whether the household as a whole falls below the threshold. These approaches can yield different results because households vary in size and composition. Some analyses focus on family units, excluding unrelated individuals living in the same household, while others use broader household definitions that include all co-residents who share resources. Core debates continue to shape poverty research and policy. The absolute versus relative poverty debate examines whether deprivation should be defined in universal subsistence terms or in relation to societal standards. The income versus consumption debate asks whether flow measures or stock measures better capture economic resources. Questions of measurement accuracy consider how reliably surveys capture income, consumption, and wealth, given underreporting, informal economic activity, and sampling challenges. The monetary versus multidimensional debate explores the extent to which poverty should be defined purely in financial terms, or should incorporate broader dimensions of well-being. Poverty is complex and multiply-determined, meaning no single factor fully explains economic deprivation. Poverty outcomes reflect the interaction of individual characteristics, such as education and health, household factors such as family structure and wealth, labour market conditions, such as wages and employment opportunities, policy environments, such as tax and transfer systems, and structural factors, such as discrimination and geographic isolation. Research consistently shows that individuals experiencing poverty often face multiple overlapping constraints simultaneously, underscoring the value of systematic economic study in uncovering the hidden mechanisms that shape material deprivation and economic opportunity. Economic systems refer to the institutional arrangements through which societies organize production, distribution, and consumption of goods and services. All economic activity originates from the coordinated interaction of markets, governments, firms, and households. These interconnected institutions form an integrated network that determines what goods are produced, how they are produced, who receives them, and at what prices exchange occurs. The economic system establishes the rules, incentives, and constraints that shape individual and collective behavior. Market economies allocate resources primarily through decentralized exchange between buyers and sellers. The fundamental mechanism is the price system, in which prices serve as signals that coordinate economic activity. When demand for a good increases, its price rises, signaling producers to supply more and consumers to purchase less. When supply increases, prices fall, encouraging consumption while discouraging production. This adjustment process, operating without central direction, guides resources toward their most valued uses. Scottish economist Adam Smith described this coordination as an invisible hand, whereby individuals, pursuing their own interests, inadvertently promote social welfare by responding to price signals. Markets function through the interaction of supply and demand. Supply refers to the quantity of a good or service that producers are willing and able to sell at various prices during a specific time period. The law of supply states that quantity supplied increases with price, holding other factors constant, because higher prices make production more profitable and enable coverage of higher marginal costs. Demand refers to the quantity that consumers are willing and able to purchase at various prices. The law of demand states that quantity demanded decreases as price increases, holding other factors constant, because higher prices reduce purchasing power and make substitutes relatively more attractive. Market equilibrium occurs at the price where quantity supplied equals quantity demanded, clearing the market with no excess supply or demand. Markets transmit information efficiently when prices reflect underlying scarcities. A drought that reduces wheat supply causes wheat prices to rise. This price increase signals consumers to economize on wheat products and encourages farmers to plant more wheat next season. No central planner needs to understand local conditions or issue directives. The price system aggregates dispersed information and coordinates behavior across millions of participants. This informational efficiency represents one of the primary advantages of market allocation. Market economies also depend on factor markets, where inputs to production are bought and sold. The labour market coordinates workers seeking employment with firms seeking labour services. The capital market channels savings from households to firms that invest in productive equipment and structures. The land market allocates real estate and natural resources. Factor prices, wages for labour, interest rates for capital, and rents for land perform the same coordinating function as product prices. High wages in an occupation signal labour scarcity and attract additional workers. High interest rates signal capital scarcity and encourage saving while discouraging investment. Markets generate efficiency under specific conditions. Perfect competition describes an idealized market structure with many buyers and sellers, homogeneous products, perfect information, and free entry and exit. Under these conditions, market outcomes are Pareto efficient, meaning no individual can be made better off without making someone else worse off. Resources flow to their highest valued uses. Production occurs at minimum cost and prices equal marginal costs. This result provides the theoretical foundation for market-oriented policy prescriptions. However, real-world markets deviate substantially from perfect competition. Market failures occur when unregulated markets produce inefficient outcomes. Externalities arise when economic activities impose costs or benefits on third parties not involved in the transaction. Pollution represents a negative externality because firms do not bear the full social cost of their emissions, leading to excessive production of polluting goods. Education generates positive externalities because educated individuals benefit society beyond their own gains, potentially leading to underinvestment. Externalities cause market prices to diverge from social costs and benefits, resulting in inefficient resource allocation. Public goods represent another source of market failure. Public goods are characterized by non-rivalry, meaning one person's consumption does not reduce availability for others, and non-excludability, meaning individuals cannot be prevented from consuming once the good is provided. National defense exemplifies a public good because protecting one citizen does not diminish protection for others, and all residents benefit regardless of whether they pay. Markets undersupply public goods because firms cannot capture full value through private sales when consumers can free ride on others' contributions. Information asymmetry creates market failures when one party to a transaction possesses more information than the other. Economist George Akerlof analysed information asymmetry in used car markets, demonstrating that sellers know vehicle quality better than buyers. This information gap causes buyers to offer prices reflecting average quality, driving high-quality sellers from the market and leaving only low-quality goods, a phenomenon known as adverse selection. Similar dynamics affect insurance markets, where individuals with greater health risks seek more coverage, and labour markets, where employers cannot perfectly observe worker productivity. Joseph Stiglitz and Andrew Weiss demonstrated that credit markets exhibit information asymmetry, causing lenders to ration credit even when borrowers are willing to pay higher interest rates, because higher rates attract riskier borrowers. Monopoly power distorts market outcomes by enabling firms to charge prices above marginal cost. A monopolist faces the entire market demand curve and restricts output to maximize profit, creating deadweight loss as potential transactions that would benefit both buyers and sellers do not occur. Monopoly arises from barriers to entry, such as economies of scale, network effects, control of essential inputs, or government-granted licenses and patents. Natural monopolies occur when economies of scale are so large that a single firm can serve the market at lower cost than multiple firms. Oligopolies involve a small number of firms whose strategic interactions shape market outcomes. Firms in concentrated markets may engage in tacit collusion, maintaining high prices without explicit agreement by recognizing their mutual interest in avoiding price competition. Market concentration has increased across numerous sectors in recent decades. Studies document rising concentration ratios, measuring the market share held by the largest firms in an industry. Higher concentration is associated with increased profit margins, reduced business dynamism, and lower labor share of income. Concentrated markets disadvantage consumers through higher prices and reduced variety, while disadvantaging workers through lower wages and reduced bargaining power. Small businesses face difficulty entering markets dominated by large incumbents with economies of scale, established customer bases, and access to capital. Barriers to market entry prevent new competitors from contesting established firms. Capital requirements create barriers. When starting a business demands substantial initial investment that potential entrants cannot finance. Regulatory barriers arise from licensing requirements, zoning restrictions, and compliance costs that favour incumbents. Incumbency advantages include brand recognition, customer loyalty, and network effects, whereby a product becomes more valuable as more people use it. These barriers protect existing firms from competition, enabling them to maintain prices above competitive levels and earn excess profits. Factor markets exhibit similar imperfections. Labour markets feature monopsony power when employers face limited competition for workers. A monopsonist employer can pay wages below workers' marginal product because workers lack alternative employment opportunities. This situation is most pronounced in geographic areas dominated by a single large employer or in occupations requiring specialised skills with few potential employers. Monopsony power reduces employment below efficient levels and transfers income from workers to employers. Capital markets allocate financing based on expected returns and perceived risk. Wealthy households access credit at low interest rates secured by collateral. Financial intermediaries such as banks evaluate creditworthiness using credit scores, employment history, and asset holdings. Applicants lacking these credentials face higher interest rates or credit denial. Capital markets imperfections mean that identical investment projects receive different financing terms depending on the wealth position of the borrower. Promising business ventures by low-wealth entrepreneurs may not be funded, while less promising projects by well-connected, wealthy individuals receive financing. Land markets determine residential patterns and property values. Housing markets exhibit substantial geographic variation in prices, reflecting differences in amenities, employment opportunities, school quality, and neighbourhood characteristics. Property rights and zoning regulations shape land markets by restricting development, density, and uses. Restrictive zoning in high-opportunity areas limits housing supply, raising prices, and excluding low-income households. Property taxation affects incentives for land use and development. Land markets also exhibit path dependence, whereby historical patterns of development and segregation persist through property value differences and neighbourhood effects. The distribution of income and wealth emerges from factor market outcomes. Labour income depends on wages and employment, which reflect productivity, bargaining power, and labour market conditions. Capital income depends on asset ownership and rates of return. In market economies, factor payments accrue to factor owners, creating inequality when ownership of productive assets is concentrated. Those who own substantial capital receive returns that compound over time, while those dependent on labour income face constraints from wage levels and employment volatility. Market economies generate inequality through several mechanisms. Differences in initial endowments, whether inherited wealth or genetic abilities, translate into different earning capacities. Cumulative advantage processes amplify initial differences as early success enables investments that generate further gains. Skill-biased technological change increases returns to education and cognitive skills while reducing returns to routine labour. Globalization and trade integration affect wages differently across skill levels and industries, with low-skill workers in tradable sectors facing wage pressure from foreign competition. Financial market returns often exceed labour income growth, benefiting those with investable assets. Power asymmetries in markets affect distribution outcomes. Employers possess greater bargaining power than individual workers in negotiations over wages and working conditions, particularly when unemployment is high and workers lack alternative opportunities. Landlords exercise power over tenants through lease terms and eviction threats. Creditors dictate loan terms to borrowers lacking alternative financing. These power imbalances shape the distribution of surplus from economic transactions, determining how gains are divided between parties. Market outcomes also reflect institutional contexts. Property rights define who owns what and who can make decisions about resource use. Contract enforcement mechanisms determine whether agreements are honoured and disputes resolved. Regulatory frameworks govern permissible business practices, workplace conditions, and environmental impacts. The rule of law, corruption levels, and political stability all affect market functioning. Weak institutions enable exploitation, fraud, and rent-seeking behavior, whereby individuals profit through manipulation of rules rather than productive activity. Economic systems exhibit path dependence, meaning historical conditions shape current outcomes even after underlying causes dissipate. Initial distributions of property rights, established through conquest, colonialism, or legal systems, create persistent inequality. Infrastructure investments favor certain locations while neglecting others. Social networks and business relationships built over generations provide advantages to connected individuals. Historical discrimination affects contemporary outcomes through inherited wealth gaps, residential segregation, and differential access to opportunities. Markets also feature coordination failures, where individually rational decisions produce collectively suboptimal outcomes. The prisoner's dilemma illustrates situations where mutual cooperation yields better results than individual defection, but each party has incentive to defect regardless of the other's choice. Firms may underinvest in worker training because employees might leave for competitors. Farmers may overuse common pool resources like fisheries or groundwater because individual restraint provides little benefit if others do not also restrain. These coordination problems require collective action mechanisms, such as regulation, social norms, or repeated interactions that enable cooperation. Competition serves as a disciplining force on firms, encouraging cost minimization, quality improvement, and innovation. Competitive markets punish inefficient firms with losses and reward efficient firms with profits. This selection process channels resources toward more productive uses. However, competition intensity varies across markets and time periods. During economic downturns, reduced demand weakens competitive discipline as firms focus on survival. In concentrated markets, established firms face limited competitive pressure. Geographic isolation, transportation costs, and information barriers reduce competition in local markets. Market structures evolve through entry, exit, merger, and innovation. Successful firms grow and may acquire competitors, increasing concentration. Disruptive innovations can challenge incumbent firms and reshape industries. Technological changes alter minimum efficient scale, affecting optimal firm size. Regulatory changes such as deregulation or antitrust enforcement affect market structure. Globalization exposes domestic firms to foreign competition while enabling market expansion. These dynamic processes mean market structures are not fixed but respond to economic and policy developments. The relationship between market structure and poverty operates through multiple channels. Competitive labor markets offer more employment opportunities and exert upward pressure on wages. Competitive product markets keep prices low, increasing purchasing power for consumers. Conversely, concentrated labor markets enable employers to suppress wages, while concentrated product markets enable firms to charge high prices, reducing real incomes for workers and consumers. Access to markets matters as much as market structure, because individuals excluded from participation cannot benefit from market efficiency regardless of competition intensity. Market access depends on transaction costs, information, and social connections. Transaction costs include transportation expenses, search costs, and time required to complete exchanges. High transaction costs prevent participation in distant markets and limit options. Information barriers prevent individuals from learning about opportunities, prices, or product characteristics. Social networks provide information about job openings, creditworthy borrowers, and reliable transaction partners. Those lacking connections face higher costs and reduced opportunities. Market-based allocation has both strengths and limitations for addressing poverty. Markets efficiently coordinate decentralized decision-making and respond to changing conditions. Price signals provide information and incentives for adaptation. Competition encourages innovation and cost reduction. However, markets do not ensure equitable outcomes. Initial endowments heavily influence market outcomes, and market failures create systematic disadvantages. Those lacking wealth, skills, information, or connections face barriers to market participation and receive less favorable terms when they do participate. Unregulated markets may perpetuate or exacerbate inequality through cumulative advantage processes and power asymmetries. Understanding these features is essential for analysing how economic systems shape poverty persistence. Income refers to the flow of earnings received over a specific time period, typically from wages, salaries, business profits, or investment returns. Wealth, by contrast, refers to the stock of accumulated assets minus liabilities at a given point in time. The distinction between income and wealth is fundamental to understanding economic inequality because these two measures capture different dimensions of economic resources and generate different patterns of advantage and disadvantage across households. Income represents purchasing power available for current consumption or saving. It flows into household budgets regularly, enabling payment of expenses such as housing, food, transportation, and healthcare. Income sources vary in stability, taxation, and growth potential. Earned income derived from labour supply includes wages, salaries, bonuses, and self-employment profits. Unearned income derived from asset ownership includes interest, dividends, rental income, and capital gains. Transfer income includes government payments, such as Social Security, unemployment benefits, and cash assistance. The composition of income differs dramatically across the income distribution, with labour earnings dominating for most households, while capital income represents a larger share for wealthy households. Wealth encompasses all assets owned minus debts owed. Assets include financial holdings, such as bank deposits, stocks, bonds, and retirement accounts, as well as real assets such as real estate, vehicles, and business equity. Liabilities include mortgages, student loans, credit card debt, and other obligations. Net worth, the difference between total assets and total liabilities, measures household wealth position. Unlike income, which must be replenished continuously through earnings or transfers, wealth persists across time periods and can be drawn down or built up through saving and investment decisions. The relationship between income and wealth is asymmetric. High income enables wealth accumulation through saving and investment. However, wealth can generate income through returns on capital, creating a feedback loop whereby initial wealth advantages compound over time. A household with substantial wealth receives investment income that can be consumed, reinvested to generate further returns, or transmitted to heirs. A household with high labour income but no wealth must allocate income entirely to consumption and saving, with no existing asset base generating returns. This asymmetry means wealth concentration can persist or intensify even when income inequality remains stable. Income inequality refers to the dispersion of income across individuals or households in a population. Measurement approaches include examining the income distribution by percentile, calculating the ratio of incomes at different points in the distribution, or summarizing the entire distribution using indices. The Gini coefficient, ranging from 0 indicating perfect equality to 1 indicating perfect inequality, measures the area between the Lorenz curve, which plots cumulative population share against cumulative income share, and the line of perfect equality. Higher Gini values indicate greater concentration of income. The United States has a Gini coefficient of approximately 0.48 for household income, higher than most developed nations. Income distribution statistics reveal substantial concentration. In the United States, the top 10% of households receive approximately 50% of total income, while the bottom 50% receive roughly 13%. The top 1% alone captures approximately 20% of total income, a share that has roughly doubled since 1980. Mean income substantially exceeds median income, indicating right skewness, with a long tail of high earners pulling the average upward. The ratio of mean to median income provides a simple inequality measure, with higher ratios indicating greater concentration at the top. Income sources differ across the distribution. Lower income households derive nearly all income from labour earnings and government transfers. Middle income households rely primarily on labour earnings, with modest capital income from retirement accounts and home equity. High-income households receive substantial capital income from financial investments, business ownership, and real estate. The top 1% receive approximately 40% of their income from capital, compared to less than 5% for median households. This compositional difference matters because capital income faces lower tax rates and exhibits greater volatility and growth potential than labour income. Wealth inequality exceeds income inequality by a substantial margin. The top 10% of households hold approximately 70% of total wealth, while the top 1% hold roughly 35%. The bottom 50% hold approximately 2% of total wealth, and many households have zero or negative net worth due to debts exceeding assets. The Gini coefficient for wealth approaches 0.85, significantly higher than for income. This extreme concentration reflects both the difficulty of accumulating wealth from modest incomes and the tendency for existing wealth to generate returns that enable further accumulation. Wealth components reveal disparities in asset portfolios. Wealthy households hold diversified portfolios, including substantial financial assets such as stocks and bonds that appreciate and generate income. Middle-class households concentrate wealth in home equity, which builds slowly through mortgage payments and price appreciation. Lower-income households lack significant assets in any category and often carry debt that exceeds asset values. Vehicle ownership represents the primary asset for many low-wealth households, but vehicles depreciate rather than appreciate. Retirement accounts, concentrated among higher-income workers with access to employer-sponsored plans, represent growing shares of household wealth but remain inaccessible until retirement age. The distribution of wealth has become increasingly concentrated in recent decades. Economist Thomas Piketty documented rising wealth concentration across developed countries, showing that the wealth share of the top 1% has increased substantially since 1980. This increase reflects multiple factors, including rising stock market valuations that benefit asset owners, increasing housing prices in desirable locations, and the growing importance of inherited wealth. Piketty argued that when the rate of return on capital exceeds the rates of economic growth, wealth concentration increases mechanically as capital income and capital gains outpace wage growth. Emmanuel Saez and Gabriel Zucman analyzed US wealth trends, demonstrating that wealth concentration reached levels not seen since the 1920s. The bottom 90% of households have experienced stagnant or declining wealth shares despite overall economic growth. This reflects both limited saving capacity from modest incomes and lower returns on assets held by middle-class households. Housing wealth, the primary asset for most families, appreciated substantially in aggregate but with enormous geographic variation. Households in high-growth metropolitan areas accumulated significant housing wealth, while those in declining regions saw stagnant or falling home values. Returns to capital vary substantially across wealth levels. Wealthy households access sophisticated investment products, private equity, and alternative investments with higher expected returns. They benefit from economies of scale in investing, access to professional financial advice, and ability to hold diversified portfolios through economic downturns. Middle-class households invest primarily in housing and retirement accounts, with more modest returns and higher transaction costs. Low-wealth households lack investable assets and pay high costs for basic financial services, such as check cashing and short-term loans. This return gradient means wealth grows faster for the wealthy, amplifying initial differences. Intergenerational wealth transmission perpetuates inequality across generations. Wealthy parents transfer resources to children through multiple channels. Direct transfers include gifts, inheritances, and payment of educational expenses. Indirect transfers include access to high-quality neighborhoods and schools, social networks providing job opportunities, and provision of financial cushions that enable risk-taking such as entrepreneurship. These transfers enable children of wealthy parents to enter adulthood with substantial advantages, including educational credentials, down payments for homes, and financial security during early careers. Research on intergenerational mobility shows strong correlation between parent and child economic status. The intergenerational elasticity of income, measuring the percentage of income difference between parents that persists in children's income, ranges from 0.4 to 0.5 in the United States. This means approximately 40 to 50% of income advantages or disadvantages transmit across generations. Wealth shows even stronger intergenerational correlation, with estimates suggesting that 50 to 60% of wealth differences persist. Children born to parents in the top income quintile have approximately a 40% chance of remaining in the top quintile as adults, while children born to bottom quintile parents have less than 10% chance of reaching the top. The relationship between inequality and poverty operates through multiple mechanisms. High inequality indicates that economic gains concentrate at the top, limiting resources available for public investments in education, infrastructure, and social programs. Inequality affects relative deprivation, whereby individuals assess well-being partly by comparison to others, such that rising inequality increases the proportion of the population feeling disadvantaged. Extreme wealth concentration creates political economy effects as wealthy individuals and corporations influence policy through campaign contributions, lobbying, and media ownership. These political channels can shape taxation, regulation, and social programs in ways that preserve advantages. Income dynamics reveal patterns of mobility and persistence across the distribution. Some individuals experience income fluctuations due to job changes, unemployment spells, or family transitions. Others maintain relatively stable positions. Longitudinal studies tracking individuals over time show that most people in the bottom quintile remain there or move to adjacent quintiles, with few reaching the top. Similarly, most top quintile individuals remain near the top. This limited mobility indicates that position in the income distribution exhibits substantial persistence. The distinction between permanent income and transitory income affects inequality interpretation. Permanent income represents average income over the lifetime, while transitory income includes temporary fluctuations around that average. Inequality measured at a single point in time overstates lifetime inequality if substantial income volatility allows individuals to experience different positions across their lives. However, research indicates that lifetime income inequality is substantial and has increased, suggesting that point-in-time measures reflect genuine differences in economic circumstances rather than merely temporary fluctuations. Wealth serves multiple functions that income alone cannot provide. Wealth enables consumption smoothing across time, allowing households to maintain spending during income disruptions such as unemployment or health shocks. Wealth provides collateral for loans, enabling access to credit at favorable interest rates. Wealth generates psychological security and reduces stress associated with financial uncertainty. Wealth enables investment in high-return opportunities such as education, business ventures, and real estate purchases. Wealth confers social status and political influence. These functions mean that wealth inequality has implications beyond material consumption. Capital gains, increases in asset values, represent a major source of wealth accumulation for asset owners. Stock market appreciation, real estate price increases, and business value growth generate wealth gains that do not appear in conventional income measures. Capital gains taxation typically occurs only upon asset sale, allowing wealthy households to accumulate unrealized gains indefinitely. When gains are realized, they face preferential tax rates lower than ordinary income tax rates. This treatment advantages wealth holders and contributes to wealth concentration. Debt burdens affect net worth and financial stability. Student loan debt, totaling over $1 trillion in aggregate, reduces net worth for millions of young adults and constrains their ability to save, purchase homes, or start businesses. Credit card debt carries high interest rates that compound quickly when balances are not paid in full. Medical debt, affecting a substantial fraction of households, often results from health emergencies and insurance gaps. Debt service payments reduce current income available for consumption and saving, creating ongoing financial strain. The composition of inequality combines income flows and wealth stocks. A household's full economic resources include current income for consumption, wealth for emergencies or investment, and expected future income determining borrowing capacity. Households with high income but low wealth lack financial buffers and face precarity despite current earnings. Households with substantial wealth but modest income enjoy economic security and flexibility. Comprehensive inequality assessment requires examining both dimensions because they shape economic opportunity differently. Measurement challenges affect inequality statistics. Income underreporting, particularly of capital income and self-employment earnings, leads to underestimation of inequality. Capital gains and other forms of income do not appear consistently in standard surveys. Wealth measurement requires valuing assets such as businesses and pension rights, which poses technical challenges. Survey non-response rates increase with wealth, causing top wealth households to be underrepresented. Administrative data from tax records provides more complete coverage of high income and high wealth populations, but lacks information on some asset categories and demographic characteristics. The persistence of inequality across generations, the concentration of wealth substantially exceeding income concentration, and the divergent returns to assets across wealth levels create reinforcing mechanisms whereby initial economic advantages compound over time while disadvantages similarly accumulate, producing durable economic stratification that market forces alone do not dissipate. Labour markets refer to the mechanisms through which workers supply labour services and employers demand those services, with wages serving as the price that equilibrates supply and demand. The labour market is the primary means through which most households acquire income. Employment status, wage levels, hours worked, and job stability determine economic security and shape trajectories of income growth across the life cycle. Labour market outcomes exhibit substantial variation across individuals, occupations, industries, and geographic regions, creating divergent economic pathways. The supply of labour depends on population demographics, labour force participation decisions, and hours worked. Labour force participation refers to the fraction of the working age population, either employed or actively seeking employment. Participation rates vary by age, sex, education, and family circumstances. Participation increases through early adulthood as individuals complete education, peaks during prime working years, and declines as individuals approach retirement. Women's labour force participation has increased substantially over recent decades, but remains lower than men's, reflecting caregiving responsibilities and workplace policies. Educational attainment strongly predicts participation, with college graduates participating at higher rates than those with less education. Individual labour supply decisions involve trade-offs between work and leisure, where leisure encompasses all non-work time, including household production, caregiving, and consumption activities. Higher wages increase the opportunity cost of leisure, encouraging additional work through a substitution effect. However, higher wages also increase income, enabling workers to afford more leisure through an income effect. The net response of hours worked to wage changes depends on which effect dominates. Empirical evidence suggests that labour supply is relatively inelastic for prime age workers, meaning hours worked respond modestly to wage changes, though participation decisions show greater responsiveness. Labour demand derives from employer needs for productive inputs. Firms hire workers up to the point where the marginal revenue product of labour, the additional revenue generated by the last worker hired, equals the wage. This principle implies that employment increases when wages fall and decreases when wages rise, holding productivity constant. Labour demand depends on product demand, because firms require more workers to produce more output, and on technology and capital availability, which affect how much output workers can produce. Improvements in productivity increase labour demand at given wage levels. Wage determination reflects the interaction of supply and demand, along with institutional factors. In competitive labour markets, with many employers and workers, wages adjust to equalise quantity supplied and quantity demanded. Workers with scarce skills or high productivity command higher wages, while workers in abundant occupations or with limited skills earn lower wages. Geographic differences in labour costs reflect local supply and demand conditions, with high-cost regions offering higher nominal wages that partly compensate for elevated living expenses. Marginal productivity theory holds that workers are paid according to their contribution to output. Under perfect competition, wages equal the marginal revenue product of labour, ensuring that firms hire workers as long as they generate more revenue than they cost. This framework suggests that productivity enhancements through education, training, or technology increase wages. However, marginal productivity theory assumes competitive conditions, perfect information, and worker mobility, conditions often violated in actual labour markets. Human capital theory, developed by economist Gary Becker, treats education and training as investments that increase earning capacity. Individuals invest time and resources in skill acquisition when expected future earnings gains exceed costs. Employers value educated workers because schooling signals ability and provides job-relevant skills. Each additional year of education increases earnings by approximately 8 to 10% on average, though returns vary by field of study, institution quality, and labour market conditions. Jacob Mintzer developed wage equations estimating returns to schooling and experience, showing that earnings rise with education and work experience, but at diminishing rates. Human capital accumulation depends on access to quality education, family resources to finance schooling, and ability to forego earnings during training. Low-income youth face constraints in all three dimensions. Credit markets do not function well for human capital investment because skills cannot serve as collateral. Students from families lacking wealth must borrow, accumulate debt, or work during school, reducing study time. Quality disparities across schools mean that students from disadvantaged backgrounds often receive inferior preparation even when completing equivalent years of schooling. Unemployment represents unused labour resources and lost income for affected workers. The unemployment rate measures the fraction of the labour force without employment, but actively seeking work. 3 types of unemployment describe different underlying causes. Frictional unemployment results from normal job search and turnover as workers transition between positions. Structural unemployment arises when workers' skills do not match available jobs due to technological change, industrial decline, or geographic mismatch between workers and opportunities. Cyclical unemployment results from insufficient aggregate demand during economic downturns when firms reduce hiring and lay off workers. Unemployment affects different groups unequally. Less educated workers experience higher unemployment rates because they work in more cyclical industries, possess less firm-specific human capital, making them vulnerable to layoffs, and face more competition for available positions. Young workers have higher unemployment as they search for initial jobs and change positions frequently. Racial and ethnic minorities face elevated unemployment, reflecting discrimination, residential segregation, limiting access to job-rich areas, and concentration in industries with volatile employment. Long-term unemployment, lasting 6 months or more, is particularly damaging because extended joblessness erodes skills, creates gaps in work history that signal negative information to employers, and depletes financial resources. Labour market segmentation theory challenges the view of a unified labour market, instead describing separate primary and secondary sectors. Primary labour markets offer stable employment, relatively high wages, benefits such as health insurance and retirement plans, and opportunities for advancement. Jobs in this sector require formal credentials, provide on-the-job training, and reward seniority. Secondary labour markets feature unstable employment, low wages, minimal benefits, and limited advancement prospects. Jobs in this sector have high turnover, offer little training, and provide few pathways to primary sector positions. Workers in secondary markets face continuous job insecurity and limited ability to accumulate experience or human capital. Segmentation can trap workers in low-wage jobs. Secondary sector employment often involves irregular hours, frequent layoffs, and last-minute scheduling that prevents workers from pursuing education or finding better positions. Lack of benefits means workers must allocate larger shares of income to healthcare and retirement saving. Absence of training means skills do not improve, preventing movement to higher wage work. Labour market segmentation creates distinct groups with different opportunity structures rather than a continuum along which all workers can advance through effort and skill development. Minimum wage policies establish wage floors below which legal employment cannot occur. Economic theory predicts ambiguous employment effects depending on market structure. In competitive labour markets, minimum wages set above market clearing levels reduce employment as firms substitute capital for labour or reduce output. However, in monopolistic labour markets where employers face limited competition for workers, minimum wages can increase both wages and employment by reducing employers' ability to suppress wages below competitive levels. Economist Alan Krueger conducted influential research examining fast food employment following minimum wage increases, finding minimal negative employment effects, suggesting that monopoly power may be more prevalent than perfect competition in low-wage labour markets. Minimum wage effects depend on the level relative to prevailing wages. Modest increases affect few workers and produce small distortions. Substantial increases bind for larger fractions of the workforce and create more significant adjustment pressures. Affected workers who retain employment gain through higher earnings, while those who lose jobs or experience reduced hours suffer income losses. Some workers exit unemployment or inactivity when higher wages make work more attractive, partially offsetting employment reductions. The overall distributional impact depends on the relative magnitudes of wage gains for workers who keep jobs versus income losses for workers who do not. Monopsony power in labour markets arises when workers face limited employment alternatives. Geographic isolation, industry concentration, occupational licensing requirements, and non-compete agreements all reduce worker mobility and increase employer market power. A monopsonist employer faces an upward-sloping labour supply curve, meaning it must raise wages to attract additional workers. Unlike competitive firms that can hire any quantity at the market wage, monopsonists recognise that expansion requires wage increases for all workers. This causes marginal cost of labour to exceed the wage, leading monopsonists to hire fewer workers and pay lower wages than competitive employers. Evidence of monopsony power includes research showing that labour markets are highly concentrated, with few employers dominating many local occupational labour markets. Worker mobility is lower than models of perfect competition predict, with most workers remaining in local labour markets throughout careers. Employer-sponsored health insurance ties workers to current jobs, reducing mobility. Non-compete clauses prevent workers from joining competitors, limiting outside options. These factors grant employers power to pay wages below marginal productivity. Occupational segregation describes the concentration of demographic groups in different occupations. Gender segregation features women concentrated in service, education, and healthcare occupations, while men dominate construction, manufacturing, and management. Racial and ethnic segregation features minorities underrepresented in high-wage professional occupations and overrepresented in service and manual labour. Occupational segregation contributes to wage gaps because female-dominated and minority-concentrated occupations pay lower wages, even controlling for education and experience. Multiple mechanisms produce occupational segregation. Discrimination in hiring, promotion, and training channels groups into different occupations. Educational tracking and counselling steer students toward gender-typical or race-typical fields. Social networks that transmit job information operate within rather than across groups, limiting awareness of opportunities in atypical occupations. Workplace harassment and hostile environments discourage entry and persistence in occupations where a group faces minority status. Statistical discrimination leads employers to judge individuals based on group averages rather than individual characteristics, creating barriers even when individual qualifications are strong. Collective bargaining through labour unions affects wages, benefits, and working conditions. Unions negotiate with employers on behalf of workers, leveraging collective power that individual workers lack. Union coverage has declined substantially in recent decades, falling from approximately 30% of workers in the 1950s to approximately 10% currently. Decline reflects legal and regulatory changes, weakening union protections, economic shifts toward industries with low unionization, and active employer opposition to union organizing. Union wage premiums, the difference between union and non-union wages for similar workers, average 10 to 20%, though effects vary by industry and occupation. Wage inequality within the labour market reflects returns to skills, experience, and credentials. The college wage premium, comparing earnings of college graduates to high school graduates, has increased substantially since 1980. This increase reflects skill-biased technological change, increasing demand for cognitive and technical skills, while reducing demand for routine tasks susceptible to automation. Globalization and trade integration have pressured wages in industries competing with foreign production. Declining unionization has reduced bargaining power for less educated workers. These forces have produced wage stagnation for workers without post-secondary education, while highly educated workers have experienced continued real wage growth. Contingent work arrangements, including temporary employment, contract work, and gig economy platforms, have expanded. These arrangements offer flexibility for some workers, but often involve income volatility, absent benefits, and limited job security. Workers in contingent arrangements frequently earn lower hourly wages than comparable employees in traditional arrangements and lack access to employer-provided health insurance, retirement plans, and paid leave. Misclassification of employees as independent contractors allows employers to avoid payroll taxes and labour regulations while shifting risks onto workers. Labour market structures determine employment stability, wage levels, benefit access, and opportunities for skill development and advancement, creating divergent economic trajectories for workers with different credentials, social connections, and positions within segmented labour markets, while employer market power and reduced collective bargaining enable wage suppression that limits earning capacity for workers lacking alternative opportunities. Human capital is defined as the stock of knowledge, skills, and abilities embodied in individuals that enhances productive capacity and earning potential. Education represents the primary mechanism through which human capital is acquired, supplemented by training, experience, and health. Investment in human capital affects individual economic outcomes and aggregate economic growth, making educational access and quality central determinants of opportunity and inequality. Human capital theory, developed primarily by economist Gary Becker, treats education as an investment decision comparable to financial investment. Individuals or families allocate resources to schooling when the present value of expected future earnings gains exceeds the sum of direct costs such as tuition and fees, plus indirect costs such as foregone earnings during study. Returns to education vary across individuals based on ability, field of study, institution quality, and labour market conditions. The decision to invest depends on financial resources available to pay costs, ability to delay earnings, and expectations about future returns. Educational attainment strongly predicts lifetime earnings. Workers with bachelor's degrees earn approximately 75% more over their careers than workers with only high school diplomas. Workers with graduate degrees earn substantially more than bachelor's degree holders, though returns vary dramatically by field. Professional degrees in medicine, law, and business generate the highest financial returns, while master's degrees in education and social services yield more modest premiums. These differentials reflect both productivity differences and labour market demand for various skills. Returns to education operate through multiple channels. Additional schooling increases cognitive skills, technical knowledge, and problem-solving abilities that directly enhance productivity. Education improves non-cognitive skills, such as discipline, time management, and communication that employers value. Credentials signal ability and work readiness to employers who cannot perfectly observe worker characteristics before hiring. Social networks formed during schooling provide information about job opportunities and professional connections. These mechanisms combine to produce substantial earnings, premiums for educational attainment. Research on returns to schooling consistently finds positive wage effects. Each additional year of education increases hourly earnings by approximately 8 to 10% on average, controlling for experience and other factors. Returns appear roughly linear through secondary school and college, though some evidence suggests that completing degrees generates returns beyond the years of schooling required. Returns have increased over recent decades as technological change and globalization have raised demand for skilled workers, while reducing opportunities for less educated workers. The college wage premium, comparing college graduate earnings to high school graduate earnings, has approximately doubled since 1980. Education generates social returns beyond private benefits to individuals. A more educated workforce increases productivity and economic growth. Education reduces crime rates, improves health outcomes, and increases civic participation. Children of educated parents experience better developmental outcomes, creating positive intergenerational effects. These externalities suggest that socially optimal education investment exceeds levels individuals would choose based solely on private returns, providing economic justification for public subsidies. Access to education depends on multiple factors that vary systematically by family income and wealth. Direct costs include tuition, fees, books, supplies, and in some cases, room and board. Public K-12 education involves minimal direct costs, though families in affluent areas often pay indirectly through higher housing prices to access better funded schools. Public higher education charges, tuition averaging several $1,000s annually at community colleges and over $10,000 at four-year institutions. Private colleges and universities charge substantially more, with many exceeding $50,000 annually. These costs present barriers for families lacking savings or current income to cover expenses. Opportunity costs of education include foregone earnings during schooling. High school students forego paid work, though many combine school and part-time employment. College students defer full-time labour market entry, sacrificing 4 or more years of earnings. Graduate and professional students extend this period further. Opportunity costs are particularly salient for low-income youth whose earnings could contribute to family support or whose absence from the labour force creates hardship. Credit constraints prevent some families from financing education even when returns justify the investment, because human capital cannot serve as collateral for loans. Financial aid systems attempt to reduce barriers through grants, loans, and work-study programs. Need-based grants, awarded according to family income and assets, reduce net price for low-income students. Merit-based scholarships reward academic achievement regardless of financial need. Student loans enable students to spread costs over time, repaying from future earnings. However, aid systems have limitations. Grant aid often fails to cover full costs, requiring students to borrow or work extensively. Loan burdens weigh heavily on graduates, particularly those who do not complete degrees or enter low-paying fields. Complexity in aid applications and enrollment processes creates informational barriers that disproportionately affect disadvantaged families. Educational quality varies substantially across schools and districts. Public school funding relies heavily on local property taxes, creating direct links between neighbourhood wealth and school resources. High-income districts have newer facilities, smaller class sizes, more experienced teachers, advanced coursework offerings, and extensive extracurricular programs. Low-income districts struggle with deteriorating buildings, larger classes, teacher turnover, limited course offerings, and fewer support services. These resource disparities translate into achievement gaps, with students in poorly resourced schools demonstrating lower test scores, graduation rates, and college enrollment rates. Teacher quality represents a critical input to education production. Research demonstrates that teacher effectiveness varies substantially and affects long-term student outcomes, including earnings. Effective teachers increase student test scores, high school graduation rates, and college enrollment. However, teacher quality distributes unevenly across schools and districts. High-poverty schools experience greater difficulty attracting and retaining experienced teachers, face higher turnover rates, and employ more teachers without full credentials. Compensation structures that base pay on seniority and credentials rather than performance, combined with challenging working conditions in disadvantaged schools, channel the most effective teachers toward affluent districts. Achievement gaps by socioeconomic background emerge early and persist throughout schooling. Children from high-income families enter kindergarten with larger vocabularies, stronger pre-literacy and numeracy skills, and better behavioral regulation than children from low-income families. These gaps reflect differences in parental time investment, cognitively stimulating home environments, access to high-quality preschool, and neighborhood resources. Economist James Heckman demonstrated that early childhood investments generate particularly high returns, as skills acquired early enable subsequent learning, while skill deficits compound over time. Achievement gaps widen through schooling as advantaged students access better schools, additional tutoring and test preparation, enrichment activities, and parental support in navigating educational systems. Disadvantaged students face obstacles including residential instability, food insecurity, inadequate healthcare, and exposure to violence that interfere with learning. Summer learning loss, whereby students from low-income families lose academic ground during breaks, while affluent students maintain or advance skills, contributes to cumulative disadvantage. College enrollment and completion rates vary dramatically by family income. Among high school graduates in the top income quartile, approximately 80% enroll in college and roughly 60% complete bachelor's degrees within 6 years. Among graduates in the bottom quartile, approximately 50% enroll and fewer than 15% complete degrees in the same time frame. These disparities reflect differences in academic preparation, financial resources, information about college options and aid availability, and support systems during enrollment. Many low-income students who are academically qualified for selective colleges never apply, lacking information and encouragement. Student debt has increased substantially as tuition rises and grant aid fails to keep pace. Borrowers accumulate average debts exceeding $30,000 for bachelor's degrees, with many owing considerably more. Graduate students, particularly in professional programs, often borrow over $100,000. Debt burdens constrain post-graduation choices, reducing ability to save, purchase homes, start businesses, or pursue low-paying but socially valuable careers. Default rates are highest among students who borrow but fail to complete degrees, as they face debt obligations without earnings premiums. Signaling theory, developed by economist Michael Spence, offers an alternative interpretation of educational returns. Rather than directly increasing productivity, education may primarily signal pre-existing ability to employers who cannot perfectly observe worker characteristics. Employers use credentials as screening devices, hiring college graduates, even when job tasks do not require college-level skills. If education functions mainly as a signal, private returns remain positive for individuals who invest in credentials, but social returns are lower because education does not increase overall productivity. Distinguishing between human capital and signaling effects proves difficult empirically. Evidence that education predicts earnings, even within occupations, and that earnings increase with education conditional on ability measures suggests genuine skill development. However, the concentration of returns at degree completion points and the value of credentials from prestigious institutions beyond measured learning suggests signaling plays some role. Most economists conclude that education involves both human capital accumulation and signaling, with relative importance varying by level and field. Vocational and technical education provides alternatives to traditional four-year college degrees. Community colleges offer associate degrees and certificates in applied fields such as nursing, information technology, and skilled trades. Apprenticeship programs combine on-the-job training with classroom instruction. For-profit training programs target specific occupational skills. These pathways can provide good returns for students who enter high-demand fields, particularly in healthcare, advanced manufacturing, and technology. However, quality varies enormously across programs, and some for-profit institutions charge high tuition while providing poor outcomes, leaving students with debt but without marketable skills. Occupational licensing requirements shape educational investments by requiring specific credentials for market entry. Licensed occupations, including healthcare providers, teachers, lawyers, and many skilled trades, mandate completion of approved programs and passage of examinations. Licensing can protect consumers from low-quality services, but also creates barriers to entry that reduce competition and raise costs. Requirements may exceed levels necessary for competent practice, serving incumbent interests rather than public welfare. Low-income individuals face particular difficulties meeting licensing requirements when prerequisite education is costly or when experience must be accumulated through unpaid internships. Online education and educational technology have expanded access to learning resources. Massive open online courses provide free content from leading universities to global audiences. Degree programs delivered online enable working adults to pursue credentials while maintaining employment. Adaptive learning software personalizes instruction to individual needs. However, completion rates in free online courses remain extremely low, suggesting that unstructured access to content alone proves insufficient for most learners. Effective use of technology requires course design, instructor engagement, and student support services. Disadvantaged students may lack reliable internet access, appropriate devices, and home environments conducive to online learning. Educational attainment creates cumulative advantages across the life cycle, determining not only earnings levels, but also employment stability. Benefits access, opportunities for continued skill development, and resilience to economic disruption. While educational access remains stratified by family economic resources, perpetuating intergenerational inequality through differential human capital accumulation. Credit refers to the ability to borrow funds for consumption or investment, with repayment occurring in the future. Financial markets allocate credit across borrowers based on risk assessment, collateral availability, and expected returns, creating systematic differences in access. The availability and cost of credit profoundly affect economic opportunity because borrowing enables households to smooth consumption across time, invest in education and housing, start businesses, and weather income shocks. Exclusion from credit markets or access only at prohibitive costs constrains economic activity and perpetuates disadvantage. Financial systems encompass institutions and markets that facilitate saving, borrowing, investment, and payment transactions. Commercial banks accept deposits and make loans. Credit unions operate as member-owned cooperatives, providing similar services. Investment banks facilitate corporate finance and securities trading. Insurance companies pool risk across policyholders. These formal institutions serve primarily middle-class and affluent households with steady incomes, substantial assets, and established credit histories. Households outside these parameters face barriers to accessing mainstream financial services. Credit markets operate through intermediation between savers and borrowers. Households with excess current income deposit funds in banks, receiving interest. Banks lend these funds to borrowers, charging higher interest rates than they pay depositors. The interest rate spread compensates banks for administrative costs, default risk, and profit. Efficient intermediation channels savings toward productive investments, enabling economic activity that would not occur if borrowers relied solely on current income. However, intermediation requires information about borrower creditworthiness and mechanisms to enforce repayment. Interest rates vary across borrowers according to perceived risk. Lenders assess default probability based on income stability, employment history, existing debts, assets available as collateral, and credit scores that summarize past borrowing behavior. Prime borrowers with high incomes, substantial assets, and excellent credit histories access credit at relatively low interest rates, often below 5% annually for mortgages and auto loans. Subprime borrowers with limited assets, inconsistent income, or impaired credit histories face substantially higher rates, often exceeding 10 to 20%. These differentials reflect genuine default risk, but also amplify initial disadvantages because high interest costs drain resources that could otherwise be saved or invested. Collateral requirements enable lending by providing security that lenders can seize if borrowers default. Mortgages use purchased homes as collateral, allowing lenders to foreclose if payments cease. Auto loans use vehicles as collateral. Business loans may use equipment or inventory. The availability of collateral dramatically reduces interest rates because lenders face lower losses if defaults occur. However, collateral requirements favor wealthy borrowers who own assets. First-time home buyers without existing equity face difficulty making down payments. Aspiring entrepreneurs without assets to pledge cannot secure business loans even when ventures appear promising. Credit constraints arise when borrowers cannot obtain desired loan amounts at prevailing interest rates. Constraints bind particularly for low-wealth households seeking to invest in education, housing, or businesses. Students from families without savings must borrow more to finance college, while some cannot borrow enough to attend at all. Aspiring homeowners lacking down payments cannot purchase even when monthly mortgage payments would be affordable. Would-be entrepreneurs with viable business ideas cannot obtain startup capital. These constraints prevent investments that would increase future earnings, creating poverty traps, whereby lack of current resources prevents accumulation of productive assets. Economists Joseph Stiglitz and Andrew Weiss analyze credit rationing, demonstrating that lenders may refuse loans even when borrowers offer to pay higher interest rates. This occurs because interest rates affect borrower behavior and the composition of applicants. Higher rates attract riskier borrowers willing to accept expensive financing because they perceive low probability of repayment. Higher rates also encourage borrowers to pursue riskier projects with higher potential returns necessary to cover debt service. These adverse selection and moral hazard effects lead lenders to ration credit by rejecting applicants rather than raising rates to clear the market. Credit rationing disproportionately affects borrowers without collateral or established relationships with lenders. Credit scoring systems attempt to predict default probability using statistical models based on borrowing history, payment timeliness, account balances relative to limits, length of credit history, and recent applications. The FICO score, ranging from 300 to 850, dominates consumer lending decisions. Scores above 740 qualify borrowers for prime rates. Scores below 620 result in subprime classifications with substantially higher costs or denial. Credit scoring enables rapid automated decisions, but embeds historical disparities because scores depend on prior access to credit. Young adults and recent immigrants lack sufficient history to generate reliable scores. Individuals who previously experienced financial distress through unemployment, medical emergencies, or other shocks carry damaged scores for years. Discrimination in credit markets operates through multiple channels. Explicit discrimination based on race or ethnicity violates fair lending laws, but historically shaped credit access through practices like redlining, whereby lenders refused mortgages in minority neighborhoods regardless of applicant qualifications. Although overt redlining is illegal, research demonstrates continued disparities in loan approval rates and interest rates offered to minority applicants with similar incomes, assets, and credit scores as white applicants. These disparities reflect both ongoing discrimination and the legacy of past exclusion that prevented minority households from accumulating wealth and credit histories. Predatory lending involves credit extended on terms that benefit lenders while harming borrowers through excessive costs, deceptive practices, or inappropriate products. Payday loans exemplify predatory lending. These short-term loans, typically 2 weeks, charge fees equivalent to annual percentage rates exceeding 400%. Borrowers provide post-dated checks or electronic payment authorization, with lenders depositing funds or withdrawing payment on specified dates. When borrowers cannot repay, they refinance loans multiple times, accumulating fees that far exceed initial principal. Payday lending targets low-income neighborhoods and operates through storefront locations and online platforms. Payday borrowers typically lack access to mainstream credit due to low incomes, poor credit scores, or insufficient banking relationships. They face genuine liquidity needs for expenses such as car repairs, utility bills, or medical costs that must be covered before the next paycheck. Traditional banks and credit unions generally do not offer small-dollar short-term loans due to high administrative costs relative to interest earned. This creates demand for payday lending despite extraordinarily high costs. Research shows that payday borrowing often leads to cycles of repeat loans and worsened financial condition rather than providing temporary assistance. Subprime mortgages represent another form of predatory lending. In the years preceding the 2008 financial crisis, lenders extended mortgages to borrowers with limited income documentation, minimal down payments, and weak credit histories. Many loans featured adjustable rates that started low but increased dramatically after initial periods, or negative amortization whereby payments did not cover interest owed. Borrowers often did not understand terms or were misled about their ability to afford payments. When housing prices stopped rising and interest rates increased, default rates surged, triggering foreclosures and the broader financial crisis. Minority borrowers received disproportionate shares of subprime loans even when qualifying for prime mortgages. Debt accumulation results from borrowing for consumption, emergencies, or investments without sufficient income to service obligations. Medical debt affects millions of households following health emergencies, chronic conditions, or gaps in insurance coverage. Hospital bills and medical procedures generate charges that quickly reach thousands or tens of thousands of dollars. Many households lacking savings or adequate insurance accumulate medical debt that they cannot repay. Providers and collection agencies pursue payment through wage garnishment, asset seizure, and lawsuits that further destabilize finances. Credit card debt carries particularly high interest rates, typically 15 to 25% annually, and compounds rapidly when balances are not paid in full. Households use credit cards to cover shortfalls between income and expenses, finance unexpected costs, or spread purchases over time. Minimum payment requirements, often 2 to 3% of balances, cover little more than interest charges, causing principal to decline slowly. Balances averaging several $1,000s per household persist for years, with interest payments consuming resources that could otherwise enable saving. Late payment fees and over-limit penalties add to costs. Credit card debt is highest among middle-income households with regular access to credit but insufficient income to avoid carrying balances. Student loan debt exceeds $1.7 trillion in aggregate, affecting over 40 million borrowers. Average debt for bachelor's degree recipients approaches $30,000, with graduate students often owing substantially more. Student loans differ from other consumer debt because they cannot be discharged in bankruptcy except under extreme hardship. Interest accrues during forbearance and deferment periods when payments are suspended due to unemployment or financial difficulty. Income-driven repayment plans base monthly payments on borrower earnings but extend repayment terms to 20 or 25 years. Unpaid interest capitalizes into principal, causing balances to grow even as borrowers make payments. Bankruptcy provides legal protection for debtors unable to repay obligations. Chapter 7. Bankruptcy liquidates non-exempt assets to pay creditors and discharges remaining unsecured debts. Chapter 13. Bankruptcy establishes repayment plans over 3 to 5 years. Bankruptcy filing rates increase during economic downturns when unemployment rises and incomes fall. Medical expenses represent a leading cause of bankruptcy, along with job loss and divorce. Bankruptcy damages credit scores severely, preventing access to mainstream credit for years. However, it provides relief from collection actions and enables fresh starts for households overwhelmed by debt. Banking deserts, geographic areas lacking physical bank branches, affect low-income and minority neighborhoods disproportionately. Branch closures have accelerated as banks consolidate and shift toward online services. Communities without branches face reduced access to checking and savings accounts, loan products, and financial services. Residents must travel greater distances to deposit checks, withdraw cash, or conduct transactions. This increases costs and time burdens while reducing opportunities to establish banking relationships that facilitate credit access. The unbanked population, estimated at approximately 5% of US households, lacks checking or savings accounts at any financial institution. Unbanked households cite insufficient funds to maintain minimum balances, distrust of banks, privacy concerns, and prior negative experiences, such as account closures due to overdrafts. Without bank accounts, individuals face difficulty cashing paychecks, paying bills, saving securely, and building financial records. The underbanked population, an additional 13% of households, holds bank accounts but relies on alternative financial services for some transactions. Alternative financial services include check cashing outlets, money transfer services, pawn shops, and rent-to-own stores. Check cashing services charge fees typically 1 to 3% of check value, extracting costs from each paycheck. Money transfer services charge high fees for domestic and international remittances. Pawn shops provide short-term loans secured by personal property at annual percentage rates, often exceeding 200%. Rent-to-own arrangements for furniture and appliances involve total payments far exceeding retail prices. These services fill gaps left by mainstream financial institutions but impose substantial costs that drain resources and prevent asset accumulation. Financial exclusion perpetuates poverty through multiple mechanisms. Inability to save in interest-bearing accounts prevents asset growth. Lack of credit access prevents investments in education, housing, and business ventures. Reliance on high-cost alternative services extracts income that could be saved. Absence of payment records and credit histories prevents establishing creditworthiness necessary for future access. These factors combine to trap households in cash-based economies with high transaction costs and limited opportunities for economic advancement. Economist Raghuram Rajan examined financial development and economic growth, documenting that financial inclusion enables productive investment and entrepreneurship. Access to savings instruments encourages accumulation of emergency funds. Credit availability allows timing of large purchases optimally, rather than consuming only when sufficient cash is accumulated. Business credit enables entrepreneurs to invest in equipment, inventory, and expansion. However, financial development alone does not ensure equitable access, as institutions may neglect unprofitable customer segments. Derek Hamilton developed stratification economics, emphasizing group-based inequality and structural barriers. Financial market discrimination reflects not merely individual prejudice, but institutional practices and historical legacies that systematically disadvantage minority communities. Wealth gaps by race dwarf income gaps, with median black household wealth approximately 1/10 of white household wealth. This disparity reflects historical exclusion from credit markets, discriminatory lending practices, residential segregation, limiting home equity accumulation, and differential treatment in bankruptcy and debt collection. Addressing these disparities requires institutional reforms beyond individual-level interventions. Financial capability programs teach budgeting, saving, credit management, and financial planning. Evidence on effectiveness is mixed. Knowledge improvements do not consistently translate into behavior change, particularly when households face binding resource constraints. A person who understands compound interest still faces difficulty saving when income barely covers necessities. Financial education may benefit middle-class households navigating complex financial decisions, but provides limited help for low-income households whose challenges stem from insufficient income rather than poor financial management. Regulatory frameworks shape credit markets through consumer protection laws, interest rate caps, disclosure requirements, and anti-discrimination enforcement. The Community Reinvestment Act requires banks to serve low-income communities in their service areas. The Equal Credit Opportunity Act prohibits discrimination in lending. The Truth in Lending Act mandates disclosure of interest rates and terms. The Consumer Financial Protection Bureau, created following the 2008 financial crisis, regulates consumer financial products and pursues predatory lending. However, enforcement varies across administrations, and regulatory capture, whereby regulated industries influence regulators, can weaken protections. Credit access determines capacity for consumption smoothing, productive investment, and wealth accumulation, while credit market imperfections, including information asymmetries, discrimination, and predatory practices, create systematic disadvantages for households lacking wealth, formal employment, or credit histories, extracting resources through high costs while preventing investments that would enhance future economic security. Housing refers to both shelter consumption and the primary asset through which most middle-class households accumulate wealth. Residential property serves dual economic functions simultaneously. As a consumption good, housing provides essential shelter services, including protection from elements, personal space, and location determining access to employment, schools, and amenities. As an investment asset, home ownership enables wealth building through mortgage principal repayment, property appreciation, and tax advantages. This duality distinguishes housing from other major expenditures and creates profound implications for economic stratification. Home ownership represents the dominant form of wealth holding for middle-class families. Among households in the 40th to 80th income percentiles, home equity typically comprises 60 to 70% of total net worth. For households at lower percentiles who own homes, the concentration is even higher, often exceeding 80%. This contrasts sharply with wealthy households, for whom housing represents a smaller fraction of diversified portfolios, including substantial financial assets. The centrality of housing wealth means that access to home ownership and property appreciation rates fundamentally shape wealth trajectories across the distribution. Wealth accumulation through home ownership operates through several mechanisms. Mortgage payments combine interest, compensating lenders, and principal repayment, which represents forced saving. A household making mortgage payments gradually converts rental expenditures into asset accumulation. After 30 years of payments on a typical mortgage, the household owns the property free of debt. This contrasts with renting, where payments provide shelter but build no equity. The difference compounds substantially over time, creating large wealth gaps between owners and renters with otherwise similar incomes. Property appreciation generates wealth gains when housing prices increase. Real estate prices exhibit substantial long-run growth in many markets, driven by population increases, income growth, and supply constraints. Historical average annual appreciation has been approximately 3 to 4% nationally, though with enormous geographic variation. Some metropolitan areas have experienced sustained annual appreciation exceeding 6 to 8%, generating substantial wealth for homeowners. Appreciation occurs passively, requiring no additional investment beyond maintenance and accrues entirely to owners. Renters receive no benefit from price increases in the neighbourhoods where they live. Leverage amplifies returns to home ownership. A household purchasing a home with a 20% down payment effectively borrows 80% of the purchase price. If the property appreciates 5%, the owner's equity increases by 25% of the initial investment. This leverage multiplies gains during price increases, but also amplifies losses if prices fall. The 2008 housing crisis demonstrated leverage risks as property values declined sharply, leaving many homeowners with mortgages exceeding home values, a condition known as negative equity or being underwater. However, in most periods and locations, leverage has enabled modest income households to accumulate significant wealth through home ownership. Tax advantages favour home ownership. Mortgage interest and property taxes are deductible from taxable income for itemizers, reducing after-tax costs of ownership. Capital gains on primary residences are excluded from taxation up to substantial thresholds, currently $250,000 for individuals and $500,000 for married couples. These provisions reduce effective ownership costs and increase after-tax returns relative to renting. However, tax benefits accrue disproportionately to higher-income homeowners who face higher marginal tax rates and are more likely to itemize deductions. Recent increases in standard deductions have reduced the fraction of homeowners benefiting from itemized deductions. Mortgage markets determine access to home ownership by providing financing that enables purchase without full cash payment. Conventional mortgages require down payments, typically 20% of purchase price, though lower down payment loans are available through Federal Housing Administration programs and other channels. Borrowers must demonstrate sufficient income to cover mortgage payments, property taxes, insurance, and other housing costs, generally requiring that housing expenses not exceed 28 to 31% of gross income. Credit history and credit scores affect approval and interest rates offered. Down payment requirements create barriers for households lacking accumulated savings. A 20% down payment on a median-priced home requires tens of thousands of dollars in most markets and over $100,000 in expensive metropolitan areas. Households with modest incomes can save these amounts only over many years, during which time rising prices may make home ownership increasingly unaffordable. First-time buyers without existing home equity face particular difficulty accumulating down payments. Parental assistance through gifts or loans is common among middle-class and affluent buyers, but unavailable to those from low-wealth families, creating intergenerational transmission of home ownership status. Residential segregation by race and income shapes neighborhood conditions and property values. Historical policies including racially restrictive covenants, discriminatory lending, and urban renewal programs concentrated minority populations in specific areas while reserving others for white residents. Although explicit discrimination is illegal, segregation persists through mechanisms including income inequality, steering by real estate agents, discrimination in lending and rental markets, and preferences for same-race neighbors. Segregated neighborhoods exhibit systematic differences in school quality, safety, amenities, and environmental conditions. Neighbourhood effects influence economic outcomes through multiple channels. Children growing up in high-opportunity neighbourhoods with quality schools, low poverty rates, and strong social capital experience better educational attainment, higher earnings as adults, and lower incarceration rates. Economist Raj Chetty and colleagues analysed neighbourhood effects using administrative data, demonstrating that each year of childhood exposure to better neighbourhoods improves adult outcomes. These findings suggest that residential location substantially affects intergenerational mobility, making housing access and residential patterns central to economic opportunity. Property appreciation exhibits enormous geographic variation, reflecting local economic conditions, housing supply constraints, and demographic trends. Coastal metropolitan areas with strong employment growth and restrictive zoning have experienced rapid price increases, often exceeding 6 to 8% annually over extended periods. Declining industrial cities have seen stagnant or falling prices. This divergence creates wealth inequality across regions. Homeowners in appreciating markets accumulate substantial equity that enables retirement security, educational funding for children, and business investment. Homeowners in stagnant markets build little wealth beyond principal repayment and may experience losses if prices decline. Zoning and land use regulations affect housing supply and affordability. Restrictive zoning limits housing density through minimum lot sizes, height restrictions, and prohibitions on multifamily development. These regulations reduce supply in high-demand areas, raising prices and rents. Zoning decisions reflect political processes in which current homeowners often favour restrictions that protect property values by limiting new development. Exclusionary zoning effectively prevents low-income and moderate-income households from accessing high-opportunity communities through pricing mechanisms, even when explicit discrimination is absent. Housing affordability has deteriorated in many markets as price and rent growth has exceeded income growth. The conventional standard defines housing as affordable if costs do not exceed 30% of household income. By this measure, approximately 30% of US households are cost-burdened, spending more than the threshold. Cost burden rates exceed 50% among renters in the bottom income quintile, indicating that housing costs consume disproportionate shares of limited budgets and leave insufficient resources for other necessities, including food, healthcare, and transportation. Rent burden affects financial stability and wealth accumulation. Households spending excessive shares of income on rent cannot save for down payments, build emergency funds, or invest in education. High housing costs force trade-offs with other expenditures, including nutrition, healthcare, and children's activities. Geographic mobility is constrained because moving requires deposits and fees that cash-strapped households cannot accumulate. Employment opportunities may be refused because workers cannot afford rent in job-rich areas. These constraints reduce economic flexibility and opportunity. Eviction has become a widespread phenomenon, affecting millions of households annually. Sociologist Matthew Desmond documented eviction processes and consequences through ethnographic research in Milwaukee. Eviction typically results from inability to pay rent due to job loss, health emergencies, or income fluctuations. Eviction records create barriers to future housing as landlords screen applicants and reject those with eviction histories. Families experiencing eviction often cycle through substandard housing, overcrowded conditions with relatives, or periods of homelessness. Children experiencing eviction demonstrate academic disruption, behavioral problems, and reduced long-term outcomes. Eviction's destabilizing effects extend far beyond immediate housing loss. Discrimination in housing markets persists despite fair housing laws prohibiting differential treatment. Audit studies in which researchers send matched pairs of testers to inquire about housing consistently find that minority applicants receive fewer responses, are shown fewer properties, are quoted higher prices, and face more stringent application requirements. Discrimination occurs in both rental and sales markets across diverse geographic areas. Mechanisms include agent steering towards specific neighbourhoods, differential encouragement to make offers, and harsher scrutiny of financial qualifications. These practices limit housing choices and channel minority households toward neighbourhoods with fewer opportunities. Mortgage lending discrimination has been documented through multiple research approaches. Analysis of Home Mortgage Disclosure Act. Data shows that minority applicants face higher denial rates and receive less favourable interest rates than white applicants with similar incomes, credit scores, and down payments. Some disparities reflect objective risk factors and credit history differences, but substantial gaps remain after accounting for observable characteristics. Lending discrimination limits home ownership access and channels minority borrowers towards subprime products with higher costs and foreclosure risks. Home ownership rates vary dramatically across demographic groups. Approximately 75% of white households own homes, compared to 45% of black households and 48% of Hispanic households. These gaps reflect income and wealth differences, credit market discrimination, and differential intergenerational transfers. Home ownership gaps translate directly into wealth gaps because home equity constitutes the primary asset for most families. The black-white wealth gap vastly exceeds the income gap, with median black household wealth approximately 1/10 of white household wealth. Housing market outcomes contribute substantially to this disparity. Subprime mortgages disproportionately affected minority borrowers during the housing boom and bust cycle of the 2000s. Lenders targeted minority neighbourhoods with high-cost loans featuring adjustable rates, prepayment penalties, and balloon payments. Many borrowers qualified for prime mortgages based on incomes and credit, but were steered to subprime products that generated higher fees and profits for lenders. When housing prices stopped rising and interest rates increased, foreclosures surged, destroying wealth accumulated through home ownership and damaging credit scores that affect housing access for years. Foreclosure devastates household finances and neighbourhoods. Homeowners lose equity invested in properties and face damaged credit, preventing future home ownership. Neighbourhoods with high foreclosure rates experience property value declines as vacant homes deteriorate and distressed sales establish lower price benchmarks. The 2008 financial crisis triggered approximately 8 million foreclosures over several years, with concentrations in minority communities. Foreclosure wiped out decades of wealth accumulation for many families and reversed home ownership gains achieved in previous years. Housing instability affects children's development and educational outcomes. Frequent moves disrupt schooling, peer relationships, and family routines. Children in unstable housing demonstrate lower academic achievement, higher behavioural problems, and increased health issues. Stability provides benefits beyond shelter, including consistent school enrolment, established social networks, and predictable environments enabling effective parenting. Home ownership provides greater stability than renting because owners control occupancy and face less risk of forced moves. Public housing and rental assistance programs serve low-income households unable to afford market-rate housing. Public housing provides government-owned rental units at subsidized rates. Section 8 vouchers enable recipients to rent privately owned units, with government subsidizing the difference between market rent and tenant contribution, typically 30% of income. However, funding limitations mean that assistance reaches only approximately 25% of eligible households. Long waiting lists, often years long, prevent immediate access. Geographic concentration of assisted housing in disadvantaged neighbourhoods limits access to opportunity-rich areas. Affordable housing development faces multiple barriers. Construction costs, land acquisition expenses, and financing requirements create challenges for non-profit developers seeking to build low-income housing. Zoning restrictions limit where affordable housing can be located. Community opposition, termed Not in My Backyard or NIMBY, frequently blocks proposals for affordable housing in affluent areas. Federal low-income housing tax credits provide the primary financing mechanism for affordable housing development, but generate insufficient units to meet demand. Manufactured housing provides a lower-cost home ownership option for some families. Mobile homes or manufactured homes cost substantially less than traditional site-built homes. However, owners often lease land in mobile home parks rather than owning the land underneath their homes. This creates vulnerability to rent increases and potential eviction if park owners sell property for redevelopment. Manufactured homes typically depreciate rather than appreciate, providing shelter but limited wealth-building potential. Financing for manufactured housing comes with higher interest rates and shorter terms than conventional mortgages. Housing wealth provides benefits beyond direct consumption value. Home equity can be extracted through refinancing or home equity loans to finance consumption, education, or business investment. Home ownership provides collateral that improves access to other forms of credit. Housing wealth enables downward mobility protection, as equity can be liquidated during emergencies. Home ownership facilitates retirement security, as seniors can age in place without rent obligations or extract equity through reverse mortgages. These functions make housing wealth central to financial security across the life cycle. Intergenerational transfers of housing wealth perpetuate advantage. Parents who are homeowners can provide down payment assistance to children, enabling home ownership at younger ages. Some parents transfer homes directly through gifts or below-market sales. Inherited homes or proceeds from estate sales provide windfalls that accelerate wealth accumulation. These transfers concentrate among families with existing housing wealth, creating path dependence whereby home ownership status transmits across generations. Families without home ownership lack these resources to provide children, perpetuating disparities. Geographic mobility patterns respond to housing costs and opportunities. High housing costs in economically dynamic regions prevent migration of low-income workers who could benefit from employment opportunities. Declining regions with low housing costs face difficulty attracting residents and businesses. This sorting creates divergent regional trajectories and concentrates poverty in areas with limited economic opportunity. Housing market conditions interact with labour markets to shape geographic patterns of economic activity and population distribution. Gentrification processes transform low-income neighbourhoods through private investment and demographic change. Rising property values benefit incumbent homeowners through appreciation but displace renters through increasing rents and property tax increases that force moves. Gentrification improves neighbourhood amenities and services but often occurs without benefiting long-term residents who are pushed out. Debate persists about whether gentrification represents neighbourhood improvement or displacement of vulnerable populations. Evidence suggests that both processes occur with outcomes depending on local contexts and policies. Housing market participation creates path-dependent wealth trajectories because early home ownership generates compounding returns through appreciation, forced saving via mortgage principal repayment, and leveraged gains, while rental market participation provides shelter without equity accumulation, and residential segregation concentrates disadvantaged populations in neighbourhoods with limited appreciation, poor services, and reduced opportunities for intergenerational mobility. Healthcare systems refer to the institutional arrangements through which medical services are financed, delivered, and allocated across populations. Health status influences economic outcomes through effects on productivity, employment capacity, and medical expenditure burdens. The relationship between health and economic security is bidirectional. Poor health reduces earning potential and increases costs, while poverty creates conditions that damage health and limit access to medical care. This feedback loop perpetuates disadvantage across time and generations. Healthcare financing in the United States operates through a mixed system combining private insurance, public programs, and direct out-of-pocket payments. Employer-sponsored insurance covers approximately 55% of the non-elderly population, with employers typically paying the majority of premiums. Individual purchase of private insurance covers an additional 7%. Public programs including Medicaid, Medicare, and other government insurance cover roughly 35%. The remaining population, approximately 8% or 27 million people, lacks any health insurance coverage. This fragmented system creates substantial variation in access, costs, and financial protection across populations. Health insurance functions by pooling risk across many individuals. Insurers collect premiums from all enrollees and pay medical expenses for those who require care. Healthy individuals subsidize sick individuals, making insurance viable through cross-subsidy. Insurance reduces financial risk by capping out-of-pocket expenditures and covering catastrophic costs. However, insurance introduces moral hazard, whereby coverage reduces incentives to avoid healthcare utilization and adverse selection, whereby sicker individuals disproportionately seek coverage. These challenges shape insurance market design and regulation. Employer-sponsored insurance dominates private coverage because tax policy treats employer premium contributions as non-taxable compensation. This subsidy, valued at several $1,000s annually per covered worker, encourages employers to offer insurance and employees to accept it. However, employment-based coverage creates job lock, whereby workers remain in positions to retain health benefits rather than seeking better opportunities. Job changes risk coverage gaps. Unemployment typically results in coverage loss, unless individuals purchase continuation coverage at full cost through COBRA provisions, which few can afford. Uninsured individuals face substantial barriers to medical care. They delay or forgo treatment for health problems, use emergency departments for primary care at high cost, and accumulate medical debt when they do receive care. Hospitals provide charity care to some uninsured patients, but recoup costs through higher charges to insured patients and government programs. The uninsured pay full charges without negotiated discounts that insurance companies secure, creating paradoxically higher bills for those least able to pay. Uninsured rates are highest among low-income workers in small firms that do not offer coverage, part-time workers, and individuals in states that did not expand Medicaid eligibility. Underinsurance affects individuals who hold insurance but face coverage limitations. High deductible plans require thousands of dollars in out-of-pocket spending before insurance pays. Narrow network plans restrict covered providers, requiring patients to travel long distances or pay out-of-network rates. Coverage exclusions deny payment for specific services or conditions. Annual and lifetime benefit caps limit total payments. Underinsured individuals delay care due to cost concerns, skip prescribed medications to reduce expenses, and face financial strain from medical bills despite having coverage. Medical expenditures impose substantial burdens on household budgets. Out-of-pocket spending averages over $1,000 annually per person, but varies enormously across individuals. Those with chronic conditions or acute health episodes face costs many multiples higher. Deductibles, co-payments, and co-insurance requirements shift costs from insurers to patients. Surprise billing occurs when patients unknowingly receive care from out-of-network providers at in-network facilities, generating bills for thousands of dollars. Prescription drug costs have risen rapidly, with some medications costing hundreds or thousands of dollars monthly even after insurance. Medical debt affects approximately 20% of households, totaling over $200 billion in aggregate. Healthcare providers extend credit to patients unable to pay at time of service. Unpaid bills are referred to collection agencies that pursue payment through phone calls, letters, lawsuits, wage garnishment, and credit reporting. Medical debt damages credit scores, affecting ability to obtain mortgages, auto loans, and employment. Unlike consumer debt, medical debt typically results from unpredictable health events rather than discretionary consumption choices. Many individuals with medical debt were insured when care occurred but faced out-of-pocket costs exceeding their financial capacity. Bankruptcy frequently results from medical expenses. Research indicates that approximately 60% of personal bankruptcies involve medical bills or illness-related income loss. Economist Amy Finkelstein examined the effects of health insurance coverage, showing that insurance reduces financial risk and bankruptcy incidents. The introduction of Medicare, providing insurance to seniors, substantially reduced elderly bankruptcy rates. However, medical bankruptcy remains common even among insured individuals when serious illnesses generate costs exceeding coverage limits, or when health events prevent work and cause income loss. The health poverty cycle operates through multiple pathways. Poor health reduces labor force participation and hours worked. Chronic conditions such as diabetes, heart disease, and mental illness limit ability to perform physically or cognitively demanding tasks. Disabilities prevent employment in many occupations. Acute health episodes, including injuries and infections, cause temporary work absences that reduce earnings and risk job loss. Pain and discomfort impair concentration and productivity even when individuals continue working. These effects reduce current income and impair accumulation of work experience and human capital necessary for wage growth. Medical expenses consume disproportionate shares of income for low-income households. While the wealthy devote small fractions of income to healthcare, the poor may spend 20 to 30% or more. These expenditures crowd out spending on other necessities including nutritious food, stable housing, and children's education. Households forced to choose between medications and rent, or between doctor visits and groceries, face impossible trade-offs. Medical cost burdens create financial stress that compounds health problems through mechanisms including delayed care, medication, non-adherence, and psychological distress. Health status itself reflects socioeconomic position. Mortality and morbidity rates exhibit steep gradients across income and education levels. Life expectancy for individuals in the top income quartile exceeds that of the bottom quartile by approximately 10 to 15 years. Chronic disease prevalence is substantially higher among low-income and less educated populations. These disparities reflect multiple mechanisms. Poverty creates exposures to health risks including poor housing conditions, environmental pollution, food insecurity, and violence. Stress from economic insecurity damages health through physiological pathways, including elevated cortisol, inflammation, and cardiovascular strain. Limited access to health care prevents early detection and effective management of conditions. Preventive care reduces long-term health costs and improves outcomes, but often goes unutilized by vulnerable populations. Screenings for cancer, diabetes, and hypertension enable early intervention before conditions advance. Vaccinations prevent infectious diseases. Health counseling promotes behaviors including smoking cessation, healthy eating, and physical activity. However, uninsured and underinsured individuals skip preventive care due to out-of-pocket costs. Time constraints from multiple low-wage jobs and unstable work schedules prevent appointments. Lack of transportation limits access to providers. These barriers result in delayed diagnosis, more severe illness presentation, and higher treatment costs when conditions are finally addressed. Medicaid provides health insurance for low-income individuals meeting eligibility criteria. Historically limited to specific categorical groups, including pregnant women, children, disabled individuals, and very low-income parents. The Affordable Care Act enabled states to expand eligibility to all adults below 138% of the federal poverty level. Expansion states have seen substantial coverage increases and improved health outcomes. However, many states declined expansion, leaving millions of low-income adults without affordable coverage options. Medicaid enrollment involves substantial paperwork, documentation requirements, and periodic recertification that create barriers despite eligibility. Medicare provides insurance for individuals aged 65 and older, and some disabled individuals. Traditional Medicare includes Part A covering hospitalizations, Part B covering physician services, and Part D covering prescription drugs. Beneficiaries face premiums, deductibles, and coinsurance that can total thousands of dollars annually. Many purchase supplemental Medigap policies to cover these costs. Medicare Advantage plans, offered by private insurers, provide alternative coverage with different cost structures. Medicare substantially improves financial security for seniors, but does not eliminate all medical cost burdens. Health insurance coverage affects utilization patterns. Insured individuals use more preventive care, are more likely to have regular physicians, fill prescriptions more reliably, and access specialists when needed. These differences produce better health outcomes, including lower mortality, reduced disability, and improved chronic disease management. Research comparing outcomes before and after insurance coverage gains demonstrates causal effects of insurance on health, not merely selection of healthier individuals into coverage. Emergency departments serve as safety net providers for uninsured and underinsured populations. Federal law requires hospitals to evaluate and stabilize emergency patients regardless of ability to pay. However, emergency care is costly and often inappropriate for non-emergency conditions. Uninsured patients use emergency departments for primary care needs that could be addressed more effectively and efficiently in other settings. Emergency department visits generate large bills that become medical debt when patients cannot pay. Health disparities by race and ethnicity persist, even controlling for income and insurance coverage. Minority populations experience higher rates of chronic diseases, including diabetes and hypertension, reduced access to specialty care, lower quality care when accessed, and worse outcomes for similar conditions. These disparities reflect residential segregation, concentrating minorities in areas with fewer healthcare providers, discrimination in medical settings, lower trust in healthcare institutions due to historical mistreatment, and differences in disease risk factors. Addressing health disparities requires interventions beyond insurance coverage expansion. Maternal and child health particularly affect intergenerational poverty transmission. Poor maternal health during pregnancy increases risks of low birth weight, premature delivery, and developmental problems that affect children's outcomes throughout life. Lack of prenatal care, inadequate nutrition, exposure to stress and violence, and untreated health conditions all compromise pregnancy outcomes. Infant mortality rates are substantially higher among Black infants than white infants, reflecting disparities in maternal health, healthcare access, and social conditions. Children born with health problems face elevated healthcare costs, developmental challenges, and reduced long-term earnings potential. Mental health conditions including depression, anxiety, and substance use disorders disproportionately affect low-income populations. Economic stress, trauma exposure, and adverse childhood experiences increase mental health risks. However, mental health care access is particularly limited. Insurance coverage for mental health services is often inferior to coverage for physical health, despite parity requirements. Mental health provider shortages are severe, particularly in low-income areas. Stigma prevents many individuals from seeking treatment. Untreated mental illness impairs work performance, disrupts relationships, and perpetuates poverty. Chronic diseases require ongoing management through medications, monitoring, and lifestyle modifications. Conditions including diabetes, heart disease, and asthma generate continuous costs for office visits, tests, and prescriptions. Effective management prevents complications and hospitalizations, but requires consistent care access and medication adherence. Low-income patients face difficulty affording co-payments for frequent appointments and monthly prescription costs. Gaps in coverage during insurance transitions disrupt treatment. Competing demands on limited time and resources interfere with disease management, leading to poor control and expensive complications. Disability affects economic security through reduced earning capacity and increased medical costs. Physical disabilities limit ability to perform manual labor or require workplace accommodations that some employers resist. Providing cognitive and mental disabilities affect productivity and job performance. Social security. Disability insurance provides income support for individuals unable to work, but eligibility requirements are strict, application processes lengthy, and benefit levels modest. Many disabled individuals who can work with accommodations face discrimination in hiring and advancement. Health insurance markets exhibit market failures that justify government intervention. Adverse selection causes insurance markets to unravel as healthy individuals exit, leaving only sick individuals whose costs exceed affordable premiums. Pre-existing condition exclusions and medical underwriting historically denied coverage to those who needed it most. The Affordable Care Act addressed these failures through individual mandates, subsidies, and regulations prohibiting discrimination based on health status. However, coverage remains incomplete and costs continue rising. Pharmaceutical costs impose particularly severe burdens. Insulin prices have increased many-fold over recent years despite minimal innovation, forcing diabetics to ration life-sustaining medication. Specialty drugs for cancer, hepatitis, and other conditions cost tens or hundreds of thousands of dollars annually. Patents and monopoly pricing enable pharmaceutical companies to charge amounts far exceeding production costs. Some patients cannot afford prescribed medications, even with insurance. Others travel to other countries to purchase drugs at lower prices or skip doses to stretch supplies. Healthcare systems in other developed countries provide universal coverage through various financing mechanisms. Single-payer systems in countries such as Canada and the United Kingdom finance healthcare through taxation and provide services to all residents. Multi-payer systems in countries such as Germany and Switzerland require universal insurance but maintain multiple insurers. These systems achieve lower costs per capita and superior health outcomes on many metrics compared to the United States. However, they involve trade-offs including tax burdens, waiting times for non-urgent care, and limits on patient choice. Health shocks represent a primary mechanism through which poverty persists because illness simultaneously reduces income through work limitations, while increasing expenses through medical costs, and inadequate insurance leaves vulnerable populations exposed to catastrophic financial consequences. that deplete savings, create debt, and damage creditworthiness while compromising health itself through delayed care and medication non-adherence. Social mobility is defined as the extent to which individuals move up or down the economic ladder relative to their parents' position. It represents a fundamental measure of economic opportunity because high mobility indicates that outcomes depend primarily on individual effort and ability rather than family circumstances, while low mobility suggests that advantages and disadvantages transmit across generations. Mobility measurement assesses whether economic systems provide genuine opportunities for advancement or perpetuate hereditary stratification. Economists distinguish between intergenerational mobility and intragenerational mobility. Intergenerational mobility compares economic status across generations, typically examining the relationship between parent income and adult child income. High intergenerational mobility means weak correlation between parent and child positions, indicating that children's outcomes are largely independent of family origins. Low intergenerational mobility means strong correlation, indicating substantial transmission of advantage and disadvantage. Intragenerational mobility describes movement within an individual's lifetime, such as earnings changes from early career to peak earning years. Both concepts capture important dimensions of economic opportunity. Absolute mobility refers to whether children achieve higher living standards than their parents, typically measured by comparing inflation-adjusted incomes at similar ages. If economic growth raises all incomes, absolute mobility can be high, even when relative positions remain unchanged. Children may earn more than their parents earned at the same age, while maintaining the same rank in the income distribution. Relative mobility refers to changes in position within the income distribution across generations. A child moving from the bottom quintile to the top quintile demonstrates high relative mobility, regardless of absolute income levels. The distinction matters because absolute mobility depends on economic growth rates, while relative mobility depends on the strength of intergenerational transmission of economic status. Intergenerational income elasticity measures the percentage change in child income associated with a percentage change in parent income. An elasticity of 0.5 indicates that children born to parents earning 100% more than average themselves earn 50% more than average as adults. Lower elasticities indicate greater mobility because parent income predicts child income less strongly. Elasticity estimates for the United States range from 0.4 to 0.5, indicating moderate to low mobility. Approximately 40 to 50% of parent income advantages or disadvantages persist in the next generation. This places the United States below most developed countries in mobility rankings. Transition matrices provide alternative mobility measurement by showing the probability of children reaching each income quintile conditional on parent quintile. Perfect mobility would feature 20% probability of reaching each quintile regardless of origin. Observed patterns show much higher probabilities of remaining in or near parent quintiles. Children born to parents in the top quintile have approximately 40% probability of remaining in the top quintile and only 7% probability of falling to the bottom quintile. Children born to bottom quintile parents have approximately 40% probability of remaining in the bottom quintile and only 8% probability of reaching the top quintile. These asymmetric transition probabilities reveal substantial persistence at both tails of the distribution. Rank-rank correlations compare parent and child positions in their respective income distributions. Economist Raj Chetty and colleagues used administrative tax data covering millions of individuals to estimate these correlations precisely. Findings show correlation coefficients of approximately 0.3 to 0.4, indicating that parent rank explains roughly 10 to 15% of variance in child rank. This leaves substantial room for individual variation, but also reveals meaningful persistence. Children of top decile parents are more than 3 times as likely to reach the top decile themselves compared to children of median income parents. Mobility barriers prevent movement across economic positions. Wealth transmission directly transfers resources through inheritances, gifts, and inter vivos transfers that finance education, home down payments, and business investments. Wealthy parents provide safety nets, enabling children to take career risks, pursue unpaid internships, or start businesses without fear of destitution. These transfers create head starts that compound through life. Network effects operate as social connections provide information about opportunities, referrals for employment, and access to informal credit. Professional and business networks are inherited through family connections, with children of affluent parents accessing social capital unavailable to those from disadvantaged backgrounds. Credentialism creates barriers as employers increasingly require formal educational credentials for positions that previously did not demand them. Degree requirements screen out capable individuals lacking credentials, even when job tasks do not require college-level skills. Credential inflation raises entry barriers and advantages those from families able to finance extended education. Unpaid internships and entry-level positions paying insufficient wages create additional screens, favouring individuals with family financial support. These mechanisms filter opportunities before merit can be demonstrated. Geographic variation in mobility is substantial. Chetty and colleagues created the Opportunity Atlas, mapping mobility rates across commuting zones throughout the United States. Some areas feature mobility rates comparable to highly mobile countries, such as Canada and Denmark, with children from bottom quintile families having 15 to 20% probability of reaching the top quintile. Other areas exhibit extremely low mobility, with probabilities below 5%. This tenfold variation suggests that place matters enormously for economic outcomes independent of individual or family characteristics. Areas with high mobility exhibit several common features. Lower income inequality and less residential segregation by income are associated with greater mobility. Better schools and higher test scores predict improved outcomes for children from all backgrounds. Lower crime rates and greater social cohesion appear beneficial. More stable family structures and higher marriage rates correlate with mobility. Larger middle-class populations and more dense communities show advantages. These patterns suggest that neighbourhood environments and local institutions shape opportunity structures. Causal evidence for neighbourhood effects comes from experimental and quasi-experimental research. The Moving to Opportunity experiment randomly assigned housing vouchers enabling low-income families to relocate from high poverty to lower poverty neighbourhoods. Children who moved to better neighbourhoods at young ages demonstrated higher earnings as adults, increased college attendance, and reduced single-parenthood rates. Each additional year of childhood spent in better neighbourhoods produced measurable improvements in adult outcomes. These findings indicate that residential location affects mobility through genuine environmental effects rather than merely sorting based on family characteristics. The Great Gatsby curve, documented by economist Miles Korak, reveals a negative relationship between income inequality and intergenerational mobility across countries. Nations with higher inequality tend to exhibit lower mobility, meaning advantage and disadvantage transmit more strongly across generations in unequal societies. The United States demonstrates both high inequality and low mobility relative to peer nations. This relationship suggests that inequality may impede mobility through mechanisms including differential investment in children, residential segregation, educational disparities, and social network stratification. Trends in absolute mobility show decline over recent decades. Economist Raj Chetty calculated that approximately 90% of children born in 1940 earned more than their parents earned at age 30, while only 50% of children born in 1980 exceeded parent incomes. This decline reflects slowing economic growth, rising inequality concentrating gains at the top, and stagnant median incomes. Absolute mobility has fallen across the income distribution, but particularly among middle-class families. Even when children achieve higher education levels than parents, earnings advantages have diminished as the returns to education have been offset by wage stagnation. Relative mobility appears stable or slightly declining over time. Intergenerational income elasticities measured for different birth cohorts show similar magnitudes, suggesting that the strength of intergenerational transmission has not changed dramatically. However, stability in relative mobility combined with declining absolute mobility means that the rungs of the economic ladder may be equally spaced, but climbing produces smaller gains. Economic stagnation at the middle and bottom of the distribution means that mobility increasingly represents reshuffling of positions rather than broadly shared prosperity. Sibling correlations provide alternative perspectives on mobility. Economist Bhaskar Mazumdar estimated correlations in adult earnings between siblings, finding coefficients of approximately 0.4 to 0.5. This indicates that siblings' earnings are substantially more similar than would be expected by chance, reflecting shared family and neighborhood influences. Sibling correlations capture broader family and community effects beyond measured parent income, suggesting that family background influences outcomes through multiple channels including genetic factors, parenting practices, neighborhood conditions, and social networks. Educational mobility, measured by comparing parent and child education levels, shows different patterns than income mobility. Educational attainment has increased across cohorts, with each generation achieving more years of schooling than the previous. However, educational advantages remain highly correlated across generations. Children of college-educated parents are far more likely to attend and complete college than children of parents without degrees. The expansion of higher education has increased educational mobility somewhat, but has not eliminated substantial persistence in educational attainment across generations. Occupational mobility examines movement across occupational categories. Sons and daughters rarely enter the exact same occupations as parents, demonstrating substantial occupational mobility as the economy shifts across sectors and specializations. However, occupational prestige and earnings exhibit strong intergenerational correlations. Children of professionals disproportionately enter professional occupations themselves, while children of manual laborers are more likely to work in similar fields. Occupational sorting based on family background reflects educational tracking, network effects, and differential exposure to career options. Mobility measurement faces challenges, including life cycle bias, as income measured at different ages captures individuals at different career stages. Permanent income, representing average lifetime earnings, provides a more appropriate measure than single-year income, but requires longitudinal data tracking individuals over extended periods. Measurement error in income data attenuates estimated mobility, causing estimates to understate true persistence. Changing household structures and non-standard families complicate comparisons across generations. These technical issues affect precise mobility estimates, but do not overturn basic findings of substantial persistence. International comparisons reveal wide variation in mobility rates. Nordic countries, including Denmark, Norway, and Finland, exhibit high mobility with intergenerational elasticities around 0.15 to 0.2, meaning only 15 to 20% of parent income advantages persist. Canada, Australia, and Germany show intermediate mobility with elasticities of 0.2 to 0.3. The United States and United Kingdom exhibit lower mobility with elasticities of 0.4 to 0.5. These differences correlate with public investment in education, healthcare, and family support, as well as labour market institutions and tax progressivity. Countries with extensive social insurance and public services demonstrate higher mobility. Policy implications depend on normative views about fairness and efficiency. High mobility is often viewed as desirable because it indicates that outcomes reflect individual merit rather than inherited privilege, and because it suggests efficient allocation of talent across occupations. Low mobility may reflect market failures, discrimination, or inefficient barriers that prevent capable individuals from reaching their potential. However, some mobility barriers reflect legitimate advantages, such as stable family environments and high parental investment in children. Distinguishing between just and unjust sources of persistence challenges policy design. Mobility patterns demonstrate that economic position exhibits substantial persistence across generations, with children's outcomes strongly predicted by family circumstances, and that geographic location creates divergent opportunity structures such that identical children would experience different adult outcomes depending on where they grow up, revealing that poverty persistence reflects structural features of economic and social systems beyond individual characteristics. Government anti-poverty policy refers to the collection of programs, transfers, and interventions designed to prevent or alleviate economic deprivation. These policies vary in structure, generosity, and effectiveness across jurisdictions and time periods. The social safety net encompasses cash assistance, in-kind benefits, tax-based transfers, and social insurance programs that collectively provide support to low-income households. Policy design shapes immediate material well-being, work incentives, and long-term opportunity structures, with seemingly technical choices about benefit levels and phase-out rates producing substantial behavioural and distributional consequences. Transfer programs are divided into three primary categories. Cash assistance provides money directly to recipients who exercise discretion over spending. In-kind benefits provide specific goods or services such as food, housing, or medical care rather than fungible income. Tax-based transfers operate through the tax system, reducing tax liability or providing refunds to eligible households. Each approach involves different trade-offs regarding recipient autonomy, administrative complexity, and effectiveness in meeting specific needs. Supplemental Nutrition Assistance Program, SNAP, formerly known as food stamps, represents the largest nutrition assistance program. SNAP provides electronic benefit cards that recipients use to purchase eligible food items at authorized retailers. Benefits are calculated based on household size and income, with maximum monthly benefits of approximately $200 per person for households with zero income, declining as income increases. SNAP serves approximately 40 million people as annual costs, exceeding $100 billion. Eligibility requires income below 130% of the poverty line and assets below specified limits. Able-bodied adults without dependents face time limits unless meeting work requirements. Temporary Assistance for Needy Families, TANF, provides cash assistance to low-income families with children. TANF replaced aid to families with dependent children in 1996 through welfare reform legislation that imposed work requirements, time limits, and increased state discretion. States receive fixed block grants and design their own programs within federal guidelines. Monthly benefits vary dramatically across states, ranging from under $200 to over $700 for a family of three. TANF caseloads have declined substantially from approximately 4 million families in the mid-1990s to fewer than 1 million currently, despite poverty rates not declining proportionally. Work requirements mandate that recipients engage in employment, job search, or training activities. Housing assistance takes multiple forms. Public housing provides government-owned rental units at subsidised rates. Section 8 Housing Choice Vouchers enable recipients to rent privately owned units, with government paying the difference between 30% of recipient income and fair market rent. Project-based rental assistance subsidises specific developments. Approximately 5 million households receive housing assistance, representing roughly 25% of eligible households. Long waiting lists, often lasting years, prevent universal coverage. Housing assistance substantially reduces housing cost burdens and improves residential stability, though concerns persist about geographic concentration of assisted housing in disadvantaged neighbourhoods. Medicaid provides health insurance for low-income individuals meeting categorical eligibility criteria. Historically limited to pregnant women, children, disabled individuals, and very low-income parents, the Affordable Care Act enabled states to expand coverage to all adults with incomes below 138% of the poverty line. Expansion states have covered millions of previously uninsured adults, improving health outcomes and financial security. Non-expansion states leave substantial coverage gaps for low-income adults who earn too much for traditional Medicaid but too little to afford marketplace insurance. Medicaid covers over 70 million people at combined federal and state costs exceeding $600 billion annually. The Earned Income Tax Credit, EITC, provides refundable tax credits to low-income working families. Credit amounts increase with earnings through a phase-in range, plateau, and then decrease through a phase-out range as income rises. Maximum credits exceed $6,000 annually for families with 3 or more children. The EITC serves approximately 25 million households at annual costs approaching $70 billion. Because the credit increases with earnings through the phase-in range, the EITC encourages labour force participation, particularly among single parents. Research by economist Hilary Hoynes demonstrates substantial employment effects, with EITC expansions increasing labour force participation among eligible populations. Child Tax Credit provides tax credits of up to $2,000 per child for families below income thresholds. Recent temporary expansions increased credit amounts to $3,600 for young children and made the credit fully refundable, enabling families with no tax liability to receive full benefits. These expansions substantially reduced child poverty during the period they were in effect. Permanent credit amounts are lower and phase out at higher income levels, providing larger benefits to middle-income families than very low-income families. Debate continues about credit structure, refundability, and work incentive effects. Unemployment insurance provides temporary income replacement for workers who lose jobs through no fault of their own. Benefits typically replace 40 to 50% of prior wages, subject to state-specific maximums, for up to 26 weeks. Extended benefit programs activate during recessions to provide additional weeks of coverage. Eligibility requires sufficient prior earnings and job separation for qualifying reasons, excluding workers who quit voluntarily or were fired for cause. Unemployment insurance serves as automatic stabilizer, increasing spending during downturns when aggregate demand weakens. Benefits support job search by enabling workers to seek appropriate positions rather than accepting the first available offer. Social Security provides retirement income, disability benefits, and survivor benefits. Although not specifically targeted at the poor, Social Security substantially reduces elderly poverty, with poverty rates among seniors approximately half what they would be without benefits. Disability insurance supports individuals unable to work due to medical conditions. Social Security operates through payroll taxation, with benefits calculated based on lifetime earnings. Progressive benefit formulas provide higher replacement rates for low earners than high earners, creating redistributive effects within the program. Benefit structures involve eligibility thresholds, benefit calculation formulas, and phase-out rates. Eligibility thresholds define income and asset limits below which households qualify for programs. Categorical eligibility restricts some programs to specific populations, such as families with children, elderly individuals, or disabled persons. Benefit calculations may provide flat amounts or vary based on household size, income, and expenses. Phase-out rates determine how benefits decline as income increases, creating implicit marginal tax rates that affect work incentives. Benefit cliffs occur when small increases in earnings cause loss of benefits, exceeding the earnings gain, creating situations where working more results in lower net income. A household earning just below an eligibility threshold receives full benefits. Earning slightly more can trigger complete loss of benefits worth thousands of dollars annually. These cliffs create strong disincentives to increase earnings through additional work hours, job advancement, or wage increases. Benefit cliffs are particularly problematic when multiple programs have similar eligibility thresholds, causing simultaneous loss of SNAP, housing assistance, Medicaid, and childcare subsidies. Effective marginal tax rates combine income taxes, payroll taxes, and benefit phase-outs to determine the fraction of additional earnings that households retain. For some low-income households, effective marginal rates exceed 50% or even approach 100% when benefit losses are included. High effective rates discourage earnings growth and create poverty traps, whereby households face little financial gain from working more despite substantial effort. Economist Robert Moffett analysed welfare program effects on labour supply, documenting that high implicit tax rates reduce work hours and employment. Program take-up rates, the fraction of eligible households that actually participate, are below 100% for virtually all means-tested programs. SNAP take-up rates are approximately 80%, meaning roughly 20% of eligible households do not receive benefits. TANF take-up is substantially lower, with fewer than 25% of eligible families enrolling. Housing assistance take-up cannot exceed capacity given limited funding. Low take-up reflects multiple factors, including lack of information about eligibility, application complexity, and documentation requirements, stigma associated with benefit receipt, and perceived benefits insufficient to justify application effort. Administrative burden affects access to programs. Application processes require extensive documentation of income, assets, household composition, and expenses. Recertification procedures demand periodic submission of updated information, with failure to comply causing benefit termination. Interview requirements and office visits impose time costs that may exceed available benefits for some households. Online applications and simplified procedures have improved access but have not eliminated barriers, particularly for individuals with limited literacy, internet access, or English proficiency. Universal programs provide benefits to all individuals meeting non-means-tested criteria, such as age, regardless of income or wealth. Social Security retirement benefits, Medicare, and public education exemplify universal approaches. Targeted programs provide benefits only to individuals meeting income or asset tests. SNAP, TANF, Medicaid, and housing assistance exemplify targeted approaches. Universal programs avoid stigma, reduce administrative costs, and achieve high take-up rates, but provide benefits to individuals who do not need assistance, reducing redistribution per dollar spent. Targeted programs concentrate resources on those with greatest need, but involve higher administrative costs, lower take-up, and potential stigma. International comparisons reveal wide variation in social policy approaches. Nordic countries operate extensive universal programs, including childcare, healthcare, and education, alongside generous targeted programs. Continental European countries combine social insurance with means-tested assistance. The United States relies more heavily on targeted programs and tax expenditures than universal provision. Total social spending as a percentage of GDP is lower in the United States than most developed countries, and US spending is more concentrated on elderly populations through Social Security and Medicare rather than working-age families and children. Poverty reduction effectiveness varies across programs. Social Security and Medicare substantially reduce elderly poverty. SNAP reduces food insecurity and improves nutrition. Housing assistance reduces homelessness and residential instability. The EITC increases employment and income. However, many programs reach only fractions of eligible populations and provide benefits insufficient to bring recipients above poverty lines. Official poverty rates measure income before taxes and most transfers, understating anti-poverty effects. Supplemental poverty measure, which includes taxes and in-kind benefits, shows larger poverty reduction, with programs reducing poverty rates by approximately 40%. Evidence from program evaluations and natural experiments informs policy design. Randomized controlled trials test program effects by comparing outcomes for treatment and control groups. Economist Janet Curry documented long-term effects of early childhood programs, showing that SNAP and Medicaid access during childhood improve adult health, educational attainment, and earnings. Welfare reform evaluations found that work requirements increased employment but did not substantially improve family income due to low wages and benefit loss. EITC expansions increase labour force participation without negative effects on children's outcomes. Behavioural responses to programme design include labour supply adjustments, household formation decisions, and fertility effects. Programmes that phase out with earnings reduce work incentives through high effective marginal tax rates. Asset tests discourage saving because accumulation above limits causes benefit loss. Marriage penalties, whereby household benefits decline upon marriage if partners' combined income exceeds single adult thresholds, may discourage marriage among low-income couples. Evidence for these effects is mixed, with some studies finding modest behavioural responses while others find minimal effects. Responses appear larger when benefit changes are substantial and salient. Work requirements mandate that recipients engage in employment or related activities as a condition of benefit receipt. TANF work requirements increased employment among welfare recipients during strong labour markets of the late 1990s, but proved more challenging during recessions when jobs were scarce. Exemptions for caregivers, disabled individuals, and students recognise that not all recipients can work. Effectiveness depends on availability of employment opportunities, childcare, transportation, and supportive services enabling work. Requirements without adequate support can push families off assistance without improving economic circumstances. Program interactions create complexity as households often receive benefits from multiple programs simultaneously. Eligibility rules and benefit calculations differ across programs, creating administrative burden for recipients who must navigate separate applications and recertifications. Benefit stacking can provide substantial support with combinations of SNAP, EITC, housing assistance, and Medicaid collectively worth over $20,000 annually. However, uncoordinated phase-outs and differing eligibility thresholds create benefit cliffs and high effective marginal tax rates. Proposals for integrated benefit systems aim to simplify administration and smooth benefit reductions. Policy design confronts trade-offs between adequacy, targeting, work incentives, and cost. Generous benefits improve well-being but cost more and may reduce work. Tight means testing concentrates resources on the neediest but creates high effective marginal tax rates and administrative complexity. Gradual benefit phase-outs improve work incentives but extend eligibility up the income distribution, increasing costs. Universal programs avoid these trade-offs but are fiscally expensive. No design dominates across all objectives, requiring difficult choices about priorities and values. Program effectiveness in reducing poverty depends not only on benefit generosity, but also on coverage, take-up, duration, and interaction with labour markets. Programs that reach all eligible households provide benefits sufficient to meet basic needs, maintain coverage during economic shocks, and facilitate, rather than discourage employment, produce larger poverty reduction at given costs. Evaluating effectiveness requires examining effects on current poverty, long-term outcomes for children, work and marriage decisions, and fiscal costs. Poverty traps refer to self-reinforcing mechanisms through which poverty perpetuates itself across time and generations. These mechanisms involve multiple domains, including credit constraints, human capital underinvestment, nutrition deficits, and psychological processes. A poverty trap exists when current deprivation prevents investments or actions that would enable escape from poverty, creating equilibria whereby households remain poor, not due to preferences or effort, but due to structural features of their economic environment. Understanding poverty traps is central to explaining persistence, because they reveal how rational individuals facing constraints may make decisions that perpetuate disadvantage. Behavioral economics integrates insights from psychology into economic analysis, recognizing that decision-making deviates systematically from the assumptions of perfect rationality underlying standard economic models. Bounded rationality describes cognitive limitations in processing information, evaluating alternatives, and solving complex problems. Present bias refers to the tendency to overweight immediate costs and benefits relative to future consequences, causing individuals to favor smaller, immediate rewards over larger, delayed rewards. Loss aversion describes greater sensitivity to losses than equivalent gains, making individuals reluctant to accept risks even when expected values are positive. These behavioral patterns affect economic decisions across domains, including saving, education, health, and employment. Economists Sendil Mullainathan and Eldar Shafir developed the concept of scarcity, arguing that insufficient resources create cognitive and behavioral consequences beyond material deprivation. Scarcity captures attention, causing individuals to focus intensely on pressing needs while neglecting other concerns. This focus enables effective response to immediate threats, but impairs consideration of long-term consequences. Scarcity also consumes mental bandwidth, reducing cognitive capacity available for other tasks. Experiments demonstrate that inducing scarcity through resource constraints or time pressure reduces performance on cognitive tests measuring attention, executive function, and fluid intelligence. The cognitive load imposed by scarcity affects decision quality. When mental bandwidth is consumed by worries about paying rent, affording food, or managing immediate crises, less capacity remains for planning, impulse control, and complex problem solving. This can lead to suboptimal decisions, including borrowing at high interest rates, forgoing preventive healthcare to address immediate needs, or accepting unfavorable employment terms due to urgency. These decisions make rational sense given immediate constraints, but may perpetuate poverty through accumulated costs and missed opportunities. Scarcity thus operates as a cognitive tax on the poor, impairing decision-making precisely when consequences are most severe. Present bias creates particular challenges for poverty escape. Many poverty-reducing investments require upfront costs in exchange for delayed benefits. Education demands years of study and foregone earnings before generating returns. Health investments such as exercise, preventive care, and medication adherence require immediate effort or expense, while benefits accrue over time. Saving requires sacrificing current consumption for future security. Entrepreneurship demands initial capital investments and risk-taking before profits materialize. Present bias causes individuals to underweight these future benefits relative to current costs, reducing investment even when returns would justify it under time-consistent preferences. Self-control problems related to present bias manifest in multiple domains. Saving proves difficult when individuals intend to save, but repeatedly choose immediate consumption. Diet and exercise plans are made, but not followed through. Educational goals are set, but studying is postponed. Job search is recognized as important, but not prioritized relative to immediate needs. These failures of self-control are not unique to the poor, but may have more severe consequences given tighter resource constraints. A wealthy individual can compensate for self-control lapses through hired help or purchase solutions, while poor individuals lack such buffers. Commitment devices that restrict future choices can help overcome self-control problems. Automatic savings programs that deduct funds before individuals can spend them increase accumulation. Illiquid savings accounts that impose penalties for early withdrawal prevent impulsive spending. Public commitments to goals create social pressure for follow-through. Economists Abhijit Banerjee and Esther Duflo documented use of informal commitment devices among the poor, including savings clubs where members pool contributions and take turns receiving lump sums, and microfinance repayment schedules that enforce regular saving through loan payments. Credit constraints create poverty traps through multiple channels. Individuals lacking collateral or credit history cannot borrow to finance productive investments, even when returns would exceed borrowing costs. This prevents investments in education, business equipment, housing improvements, or geographic mobility that would increase future earnings. Constraints bind most severely for investments with high upfront costs and long payback periods. Without access to credit, individuals must accumulate capital through saving from current income, a process that takes years or decades and may never reach sufficient levels given low incomes and competing needs. S-shaped savings functions describe a poverty trap mechanism based on returns to asset holdings. When assets are very low, returns may be insufficient to cover subsistence needs, forcing asset depletion. At intermediate asset levels, returns enable subsistence with modest saving. At high asset levels, returns exceed subsistence by substantial margins, enabling rapid accumulation. This creates multiple equilibria, with low asset and high asset positions both stable. Escaping from the low asset equilibrium requires accumulated sufficient capital to reach the increasing returns region, a jump that may be impossible given current income and competing demands. Nutrition-based poverty traps arise when inadequate caloric intake reduces work capacity and productivity. Severely malnourished individuals lack energy for physically demanding labor, reducing earnings below levels necessary to afford adequate nutrition. Better-fed workers can perform more and better work, earning higher wages that enable continued good nutrition. This creates two equilibria, one with malnutrition and low productivity, another with adequate nutrition and higher productivity. Moving between equilibria requires temporary increased consumption, not supported by current earnings, necessitating savings or credit unavailable to those in the low productivity state. Historical evidence suggests nutrition-based traps were important when populations lived near subsistence levels, as in pre-industrial societies or contemporary extremely poor regions. However, in modern developed countries, including among the poor in the United States, nutrition-based traps appear less relevant because caloric availability is not typically constraining. Instead, poor nutrition often involves excessive calories of low nutritional quality rather than insufficient calories. Other poverty trap mechanisms, including credit constraints, human capital, and behavioral factors, appear more important in contemporary contexts. Human capital poverty traps operate when investments in education or training require resources unavailable to poor families. Returns to education create increasing advantages across generations if wealthy families invest heavily in children's schooling, while poor families cannot. Children from poor families receive less investment, achieve lower educational attainment, earn lower incomes, and thus cannot invest heavily in their own children, perpetuating disadvantage. Breaking this cycle requires either extraordinary individual effort, external support through scholarships or subsidies, or public investment in quality education accessible to all. Information poverty describes systematic differences in knowledge across income levels. Poor individuals may lack information about available programs, educational opportunities, financial products, or legal rights. Information deficits lead to suboptimal decisions, including paying excessive prices, failing to access beneficial programs, or misunderstanding contract terms. Acquiring information requires time and literacy that may be limited among disadvantaged populations. Social networks that transmit information may be restricted to others facing similar constraints, limiting exposure to opportunity, enhancing knowledge. Information poverty reinforces other barriers by preventing individuals from identifying and pursuing available pathways. Social networks affect economic outcomes through information transmission, job referrals, and access to resources. Networks embedded in disadvantaged communities connect individuals to others facing similar constraints, providing emotional support but limited economic opportunities. Networks spanning to advantaged communities provide weak ties that transmit information about employment, investment opportunities, and strategies for advancement. Economist Mark Granovetter described the strength of weak ties whereby connections to diverse individuals outside immediate social circles provide access to novel information and opportunities. The poor typically have denser local networks, but fewer weak ties bridging to opportunity-rich environments. Aspirations and mental models shape economic behavior. Economist Esther Duflo and colleagues examined how exposure to possibilities affects aspirations and investments. Individuals form beliefs about feasible futures based on observed experiences. Those who have never encountered successful entrepreneurs, college graduates, or economically mobile families may not recognize these outcomes as realistic possibilities for themselves. Low aspirations reduce motivation for investments in education or business ventures that appear unrealistic. Interventions that expand mental models of possible futures can increase investment and effort by making success appear achievable. Experiments providing role models or information about successful individuals from similar backgrounds demonstrate effects on aspirations and behavior. Exposure to successful women in leadership increases girls' educational aspirations and performance. Contact with individuals who escaped poverty through specific pathways increases pursuit of those pathways. These findings suggest that poverty perpetuates partly through limited exposure to models of alternative futures, not only through material constraints. Microenterprise and small business creation offer potential poverty escape through self-employment. However, most microenterprises remain small, generate limited income, and fail within a few years. Economist Christopher Blattman conducted randomized evaluations of entrepreneurship programs, finding that capital grants and training increase business ownership, but often produce modest income effects. Many micro-enterprises operate as survival activities, generating income below wage employment, but offering flexibility, autonomy, or access when wage work is unavailable. Transformative entrepreneurship that generates substantial wealth is rare and typically requires combinations of human capital, financing, market opportunities, and social connections beyond what most poor individuals possess. Barriers to microenterprise success include small market size in poor communities, limiting customer base, competition from numerous similar enterprises, lack of business skills and financial management knowledge, insufficient startup capital, preventing achievement of efficient scale, difficulty accessing inputs and distribution channels, and vulnerability to shocks that force asset liquidation or business closure. These barriers mean that simply providing capital does not guarantee success. Complementary interventions, including training, mentoring, and market access, appear necessary but not always sufficient for transforming subsistence enterprises into growth-oriented businesses. Risk and insurance affect poverty persistence. The poor face substantial income volatility from health shocks, agricultural risks, job instability, and family disruptions. Without insurance or savings buffers, shocks force costly coping strategies, including asset sales, high-interest borrowing, withdrawing children from school, or forgoing healthcare. These responses enable short-term survival, but damage long-term prospects. Wealthier households smooth consumption across shocks through savings and insurance, maintaining investments and avoiding distressed decisions. Lack of risk management capacity perpetuates poverty by forcing responses that reduce future income even when shocks are temporary. Informal insurance through social networks provides partial risk sharing in poor communities. Families and friends provide loans, housing, or support during crises. However, informal insurance is limited because shocks often affect entire networks simultaneously, as when drought affects all farmers in a region or local economic downturns cause widespread unemployment. Formal insurance markets function poorly for the poor due to high administrative costs relative to premium levels, adverse selection as high-risk individuals disproportionately seek coverage, and moral hazard as insured individuals may reduce precautionary effort. Temptation and impulsivity create barriers to asset accumulation. When individuals face immediate consumption opportunities, self-control must be exercised to maintain saving. Temptation is particularly strong when resources are limited and material needs are pressing. Small windfalls such as bonuses or gifts are often consumed immediately rather than saved. Merchants and lenders may strategically exploit temptation and impulsivity through point-of-sale credit offers, advertising emphasizing immediate gratification, and products designed to trigger impulsive purchase. Resisting these pressures requires continual effort that depletes limited self-control resources. Economists George Akerlof and Robert Shiller analyzed how markets exploit behavioral tendencies through manipulation and deception. Predatory lending targets present bias and low financial literacy. Rent-to-own arrangements frame purchases as affordable monthly payments, while obscuring total costs many multiples of retail prices. Payday loans marketed as short-term solutions trap borrowers in repeated rollovers, generating fees far exceeding initial principal. These practices extract resources from vulnerable populations while providing little genuine benefit, functioning as poverty taxes imposed by private actors. Mental accounting describes how individuals categorize and treat money differently, depending on source and intended use. Windfalls may be consumed while regular income is carefully budgeted. Money allocated to specific purposes resists reallocation even when circumstances change. Cash earmarked for emergencies may remain untouched even when borrowing at high cost to cover regular expenses. These mental accounting practices can be beneficial by facilitating budgeting and preventing overspending, but may also lead to suboptimal decisions when rigid categories prevent efficient resource allocation. Behavioral poverty traps arise when psychological constraints and decision-making biases reinforce material deprivation. Scarcity creates cognitive load that impairs judgment. Present bias causes underinvestment in future-oriented activities. Loss aversion prevents risk-taking necessary for advancement. Limited information and social networks restrict awareness of opportunities. These behavioral factors do not replace structural explanations involving labor markets, discrimination, and policy, but interact with them. Individuals facing both material constraints and cognitive burdens may make decisions that perpetuate poverty even when individually rational given immediate circumstances. Policy implications of behavioral insights include designing interventions that account for psychological barriers. Default options in savings programs increase participation by requiring active choice to opt out rather than opt in. Simplified application processes for benefits reduce administrative burden. Reminders and prompts help individuals follow through on intentions. Commitment devices enable individuals to bind their future selves. Behavioral interventions can complement material assistance, but do not substitute for addressing structural barriers, including inadequate wages, credit constraints, and discrimination. Debates persist about interpreting behavioral patterns among the poor. Some argue that observed behaviors reflect rational responses to constraints and scarcity rather than cognitive deficits or poor decision-making. Seemingly suboptimal choices may represent best available options given limited alternatives. Present bias may be reasonable when futures are genuinely uncertain and immediate needs are pressing. Risk aversion makes sense when safety nets are absent and losses could be catastrophic. This perspective emphasizes that improving circumstances would improve decision-making rather than focusing on changing behavior given fixed circumstances. Alternative interpretations stress that behavioral patterns contribute to poverty persistence independent of material constraints. Evidence that cognitive function improves when scarcity is relieved suggests genuine causal effects of poverty on decision-making. Experiments providing resources or reducing uncertainty demonstrate behavioral changes indicating that poverty affects cognition, not merely that constrained individuals make rational choices. Both structural and behavioral factors likely contribute, with relative importance varying across contexts and individuals. Poverty trap models generate policy insights about intervention timing and magnitude. Small interventions may prove ineffective if individuals remain trapped below critical thresholds. Large one-time transfers that enable jumping to higher equilibria may succeed where smaller repeated transfers do not. Timing matters because returns to investments vary across life cycle, with early childhood investments generating particularly high returns. Sustained support may be necessary when single interventions prove insufficient to escape traps. These insights suggest that program design should consider not only immediate effects, but also whether interventions enable transition to self-sustaining trajectories. Evidence for poverty traps is mixed. Some studies find threshold effects and multiple equilibria consistent with trap models, while others find continuous relationships between inputs and outcomes. Heterogeneity across individuals and contexts means traps may bind for some populations, but not others. Credit constraints appear most severe for individuals with very low assets. Human capital traps seem more important in contexts with limited educational access. Nutrition traps are relevant in extremely poor settings, but less so in developed countries. This variation suggests that poverty trap mechanisms operate selectively rather than universally. Behavioral economics has expanded understanding of poverty by revealing psychological dimensions of economic decision-making. Scarcity imposes cognitive costs beyond material deprivation. Present bias interacts with uncertainty and constraints to reduce future-oriented investment. Information deficits and social network limitations restrict awareness of opportunities. These mechanisms complement structural explanations involving labor markets, credit constraints, and discrimination. Together, they explain how poverty persists through reinforcing interactions between material circumstances, institutional barriers, and psychological processes that collectively create conditions from which escape is difficult even when opportunities exist. Structural inequality refers to systematic advantages and disadvantages embedded in social institutions, policies, and norms that shape economic outcomes independent of individual characteristics or effort. It encompasses discrimination, segregation, political power disparities, and historical legacy effects. Structural perspectives emphasize that poverty results not only from individual decisions or market processes, but also from the organization of social systems that allocate opportunities, resources, and rewards unequally across groups. These patterns persist across generations through mechanisms that reproduce stratification even in the absence of explicit discriminatory intent. Labor market discrimination occurs when employers treat workers differently based on characteristics unrelated to productivity. Taste-based discrimination, described by economist Gary Becker, occurs when employers, co-workers, or customers prefer not to interact with members of certain groups and act on these preferences. Statistical discrimination occurs when employers use group membership as a signal of unobserved characteristics, such as productivity or reliability, applying group averages to individuals regardless of actual qualifications. Both forms reduce employment opportunities and wages for affected groups. Audit studies provide compelling evidence of discrimination. Researchers send matched pairs of applications differing only in characteristics, signaling race, ethnicity, or gender to potential employers. Identical resumes with stereotypically white names receive approximately 50% more callbacks than those with stereotypically black names. Similar disparities appear for Hispanic names and women in male-dominated fields. These experiments control for all qualifications, isolating discrimination as the causal factor. Economist Deva Pager extended audit methods to in-person applications, finding that white applicants with criminal records received more callbacks than black applicants without criminal records, revealing the compounding disadvantage of race and criminal history. Correspondent studies examining housing markets show similar patterns. Applications for rental housing receive fewer responses and less helpful information when applicants have names associated with minority groups. Testers visiting properties in person report differential treatment, including fewer units shown, less information provided, and more stringent requirements. These practices channel minority households towards specific neighborhoods and away from high-opportunity areas, perpetuating residential segregation. Residential segregation by race persists at high levels despite fair housing laws prohibiting discrimination. Dissimilarity indices measuring the fraction of one group that would need to move to achieve even distribution often exceed 0.6 for black-white segregation in major metropolitan areas, indicating high segregation. Hispanic-white segregation is somewhat lower but still substantial. Segregation results from historical policies including racially restrictive covenants, redlining by government mortgage programs, and urban renewal destroying minority neighborhoods, combined with contemporary mechanisms including discrimination in housing and lending markets, income inequality, limiting residential choices and preferences for same-race neighbours. Segregated neighbourhoods exhibit systematic differences in resources and conditions. Predominantly, minority neighbourhoods have lower property values, less tax revenue for public services, fewer grocery stores and healthcare facilities, higher crime rates, and greater exposure to environmental hazards. Schools in these neighbourhoods receive less funding, employ less experienced teachers, and produce lower test scores. Employment opportunities are more distant, requiring longer commutes or relocation. These neighbourhood disadvantages compound individual and family circumstances, creating additional barriers to economic mobility. Sociologist Patrick Sharkey documented how neighbourhood disadvantage persists across multiple generations. Most black families experiencing poverty in one generation live in similar neighbourhoods in subsequent generations, while white families experiencing poverty are substantially more likely to live in better neighbourhoods in the next generation. This persistence reflects both limited residential mobility and the durability of neighbourhood conditions. Even when individual families move, neighbourhood characteristics change slowly, preserving disadvantage. Historical investments and disinvestments in neighbourhoods create path dependence, whereby initial conditions shape long-term trajectories. Mass incarceration affects economic outcomes through multiple pathways. The United States incarcerates approximately 2 million people, with incarceration rates many times higher than comparable countries. Incarceration rates are dramatically elevated for Black and Hispanic men, particularly those with limited education. A substantial fraction of Black men experience incarceration at some point, creating widespread effects on communities. Incarceration interrupts employment, erodes job skills, and creates gaps in work history. Criminal records create legal barriers to employment in many occupations and informal discrimination by employers reluctant to hire individuals with criminal histories. Collateral consequences of incarceration extend beyond direct participants. Children of incarcerated parents experience emotional trauma, economic hardship, and reduced parental involvement. Communities with high incarceration rates face social disruption, weakened institutions, and political disenfranchisement. The economic costs include not only foregone earnings during incarceration, but also reduced lifetime earnings due to stigma and skill erosion. Economist Becky Pettit documented that incarceration conceals unemployment by removing individuals from labour force statistics, making official unemployment rates understate true joblessness among disadvantaged populations. Political power shapes economic outcomes through influence over policy, resource allocation, and institutional design. Wealth concentration translates into political influence through campaign contributions, lobbying expenditures, and media ownership. Affluent individuals and corporations influence tax policy, regulatory frameworks, social spending, and labour law in ways that often preserve advantages. Voter suppression through registration barriers, identification requirements, and polling place closures disproportionately affects low-income and minority populations, reducing their political voice. Geographic malapportionment and gerrymandering distort representation, enabling minorities of voters to control legislative majorities. The political economy perspective, advanced by economists including Daron Acemoglu and James Robinson, emphasizes that economic institutions reflect political power distributions. Groups controlling political institutions design economic rules to serve their interests. Historical power asymmetries created property rights distributions, labour regulations, and tax structures that advantaged certain groups. Contemporary power enables preservation and extension of these advantages through policy influence. This perspective suggests that economic inequality and political inequality reinforce each other, making reform difficult when those who benefit from existing arrangements control decision-making processes. Social capital refers to networks, norms, and trust that facilitate cooperation and collective action. Sociologist Robert Putnam distinguished between bonding social capital, which connects similar individuals within groups, and bridging social capital, which spans diverse groups. Bonding capital provides emotional support and mutual assistance, but may not connect to opportunity-rich environments. Bridging capital transmits information about opportunities, provides access to diverse resources, and enables upward mobility. Advantaged individuals typically possess both forms, while disadvantaged individuals may have strong bonding capital within their communities, but limited bridging capital connecting to mainstream institutions and opportunities. Network effects in employment mean that many jobs are filled through referrals and personal connections rather than open applications. Individuals embedded in professional networks learn about openings before public posting, receive recommendations that overcome employer uncertainty, and access insider information about organizational culture and requirements. Those lacking such networks rely on formal application processes, facing greater competition and less information. Network advantages accumulate because employment in mainstream firms builds additional connections, while exclusion from such employment prevents network development. Trust in institutions varies systematically by race and socioeconomic status. Historical mistreatment, including slavery, Jim Crow segregation, predatory lending, and discriminatory policing, creates justified skepticism toward government, financial institutions, and healthcare systems among minority populations. Lower institutional trust reduces willingness to engage with systems even when participation would be beneficial, affecting use of banking services, healthcare, social programs, and legal systems. Rebuilding trust requires not only ending discriminatory practices, but also acknowledging historical harms and demonstrating sustained commitment to equitable treatment. Historical persistence describes how past injustices affect contemporary outcomes through multiple transmission mechanisms. Economist Trevon Logan documented how slavery's legacy affects current wealth gaps, as enslaved populations were prohibited from accumulating property and building human capital. Post-slavery discrimination through sharecropping, convict leasing, and exclusion from New Deal programs prevented wealth accumulation. The GI Bill, which financed home ownership and education for millions after World War II, was implemented in discriminatory ways that largely excluded black veterans. Redlining by government mortgage programs from the 1930s through 1960s denied mortgage access to minority neighborhoods, preventing home ownership and wealth building. These historical exclusions created cumulative disadvantages that persist. Families that could not purchase homes missed decades of appreciation that built wealth for white families. Exclusion from quality education limited human capital development. Discrimination in employment and business access reduced earning capacity and entrepreneurial opportunities. Children born to families disadvantaged by these policies inherited reduced wealth and educational investments, transmitting disadvantage across generations even after explicit discrimination ended. Economist William Darity Jr. developed stratification economics, emphasizing group-based inequality and the need to address historical harms through reparative policies. Discrimination in credit markets has been documented through multiple methods. Analysis of home mortgage disclosure. ACT data shows that minority applicants face higher denial rates and less favorable interest rates than white applicants with similar incomes and credit scores. Some gaps reflect differences in wealth, credit history, and property characteristics, but substantial disparities remain after accounting for observable factors. Subprime lending disproportionately targeted minority neighborhoods during the housing boom, with lenders steering qualified minority borrowers toward high-cost products while offering prime mortgages to white borrowers with similar or weaker qualifications. The racial wealth gap far exceeds the income gap, with median black household wealth approximately 1/10 of white household wealth. This disparity reflects historical exclusion from wealth-building opportunities, ongoing discrimination in housing and credit markets, differential returns on education and assets across racial groups, and unequal intergenerational transfers. Closing wealth gaps would require either extraordinary individual accumulation over multiple generations or direct wealth transfers, addressing historical and contemporary discrimination. Without such interventions, wealth gaps perpetuate through mechanisms including differential investment in children's education, unequal access to home ownership, and disparate exposure to economic shocks. Intersectionality, a framework developed by legal scholar Kimberlé Crenshaw, recognizes that individuals hold multiple social identities that interact to shape experiences of advantage and disadvantage. A black woman faces not simply the sum of race and gender discrimination, but distinct forms of bias specific to the intersection of these identities. Policies or analyses that consider race or gender in isolation may miss how combined identities create unique barriers. Low-income black women, for example, face compounded disadvantages in labour markets, housing access, and healthcare that cannot be fully understood by examining race, gender, or class separately. Economic analysis increasingly recognises intersectional dynamics. Labour market outcomes vary not only by race and gender individually, but also by their interaction, with black women facing different wage gaps and employment barriers than white women or black men. Criminal justice involvement, poverty rates, and health disparities exhibit intersectional patterns that simple additive models do not capture. Policy interventions must consider how multiple axes of stratification combine to affect specific populations rather than assuming universal effects across diverse groups. Institutional quality affects economic outcomes through enforcement of property rights, contract adjudication, regulation of markets, and provision of public goods. Weak institutions enable corruption, fraud, and exploitation that harm vulnerable populations lacking resources to protect their interests. Strong institutions provide predictable rules, impartial enforcement, and accessible remedies for grievances. However, institutional quality varies across neighbourhoods and populations within countries. Poor and minority communities often experience less responsive government services, less effective policing, inferior infrastructure, and more burdensome regulations than affluent communities. The criminal justice system demonstrates stratified institutional quality. Affluent defendants access private attorneys, bail quickly, and receive favourable plea bargains or case dismissals. Poor defendants rely on overworked public defenders, remain incarcerated pre-trial due to inability to pay bail, and face pressure to plead guilty to avoid lengthy pre-trial detention, even when innocent. These disparities produce different outcomes for similar offences depending on defendant resources. The system extracts fines and fees that constitute substantial burdens for poor defendants, but trivial costs for wealthy defendants, creating effective wealth-based penalties. Concentrated poverty describes neighbourhoods where large fractions of residents live below poverty lines. Concentration amplifies disadvantage through peer effects, institutional weakness, and reduced resources. High poverty neighbourhoods struggle to maintain quality schools, attract businesses, or provide services. Social capital becomes depleted as capable individuals exit when possible, leaving remaining residents with reduced networks and support systems. Concentration creates environments where poverty appears normal and alternatives seem unrealistic, shaping aspirations and perceived opportunities. Sociologist William Julius Wilson analyzed concentrated urban poverty, documenting how deindustrialization, middle-class flight, and policy changes created high-poverty neighborhoods characterized by joblessness, family instability, and social isolation. These neighborhoods lack not only economic resources, but also institutional connections, role models, and pathways to mainstream opportunity. Addressing concentrated poverty requires place-based interventions, including economic development, housing investment, and institutional strengthening alongside individual-focused assistance. Structural explanations for poverty do not deny individual agency or responsibility, but recognize that choices occur within contexts that constrain possibilities. Rational individuals facing discrimination, residential segregation, inadequate schools, and limited employment opportunities may make decisions that appear suboptimal from outside but represent best available options given circumstances. Blaming individuals for poverty without addressing structural barriers attributes to personal failing what results from social organization. Conversely, addressing structural barriers does not guarantee individual success but expands the opportunity set within which effort and ability can be rewarded. Debates about structural versus individual explanations often reflect ideological commitments more than empirical evidence. Both individual characteristics and structural conditions affect outcomes, with relative importance varying across contexts. Some individuals overcome substantial structural barriers through exceptional effort, ability, or luck, but focusing on exceptional cases obscures the systematic patterns whereby disadvantage concentrates among particular groups facing specific structural obstacles. Policy implications differ depending on whether poverty is attributed primarily to individual deficiencies requiring behavioral change or to structural barriers requiring institutional reform. Structural inequality demonstrates that poverty persistence cannot be fully understood through individual-level analysis alone. Economic stratification emerges from the dynamic interplay between market processes, institutional arrangements, policy choices, historical legacies, and social power distributions. By examining these interconnected mechanisms, economists reveal both the complexity of poverty persistence and the multiple intervention points through which economic disadvantage might be reduced. Understanding poverty requires integrating individual behavior, market structures, policy design, and structural inequality, recognizing that economic outcomes reflect not only personal choices, but also the context within which those choices occur. I realize I made an error. I already wrote Section 11, Behavioral Economics and Poverty Traps, in my previous response. The outline shows we need Section 12 now, which is the final section about structural inequality. However, I notice I may have accidentally used Section 12's planned closing at the end of Section 11. Looking back at the outline, Section 12 should end the entire script. Let me write this final section now, ensuring it ends appropriately without using the closing I already deployed. Structural inequality refers to systematic advantages and disadvantages embedded in social institutions, policies, and norms that shape economic outcomes independent of individual characteristics or effort. It encompasses discrimination, segregation, political power disparities, and historical legacy effects. Structural perspectives emphasize that poverty results not only from individual decisions or market processes, but also from the organization of social systems that allocate opportunities, resources, and rewards unequally across groups. These patterns persist across generations through mechanisms that reproduce stratification even in the absence of explicit discriminatory intent. Labour market discrimination occurs when employers treat workers differently based on characteristics unrelated to productivity. Taste-based discrimination, described by economist Gary Becker, occurs when employers, co-workers or customers prefer not to interact with members of certain groups and act on these preferences. Statistical discrimination occurs when employers use group membership as a signal of unobserved characteristics, such as productivity or reliability, applying group averages to individuals regardless of actual qualifications. Both forms reduce employment opportunities and wages for affected groups. Audit studies provide compelling evidence of discrimination. Researchers send matched pairs of applications differing only in characteristics, signaling race, ethnicity, or gender to potential employers. Identical resumes with stereotypically white names receive approximately 50% more callbacks than those with stereotypically black names. Similar disparities appear for Hispanic names and women in male-dominated fields. These experiments control for all qualifications, isolating discrimination as the causal factor. Economist Dava Pager extended audit methods to in-person applications, finding that white applicants with criminal records received more callbacks than black applicants without criminal records, revealing the compounding disadvantage of race and criminal history. Correspondence studies examining housing markets show similar patterns. Applications for rental housing receive fewer responses and less helpful information when applicants have names associated with minority groups. Testers visiting properties in person report differential treatment, including fewer units shown, less information provided, and more stringent requirements. These practices channel minority households towards specific neighbourhoods and away from high-opportunity areas, perpetuating residential segregation. Residential segregation by race persists at high levels despite fair housing laws prohibiting discrimination. Dissimilarity indices measuring the fraction of one group that would need to move to achieve even distribution often exceed 0.6 for black-white segregation in major metropolitan areas, indicating high segregation. Hispanic-white segregation is somewhat lower but still substantial. Segregation results from historical policies, including racially restrictive covenants, redlining by government mortgage programs, and urban renewal destroying minority neighborhoods, combined with contemporary mechanisms including discrimination in housing and lending markets, income inequality limiting residential choices, and preferences for same-race neighbors. Segregated neighborhoods exhibit systematic differences in resources and conditions. Predominantly, minority neighborhoods have lower property values, less tax revenue for public services, fewer grocery stores and healthcare facilities, higher crime rates, and greater exposure to environmental hazards. Schools in these neighborhoods receive less funding, employ less experienced teachers, and produce lower test scores. Employment opportunities are more distant, requiring longer commutes or relocation. These neighborhood disadvantages compound individual and family circumstances, creating additional barriers to economic mobility. Sociologist Patrick Sharkey documented how neighborhood disadvantage persists across multiple generations. Most black families experiencing poverty in one generation live in similar neighborhoods in subsequent generations, while white families experiencing poverty are substantially more likely to live in better neighborhoods in the next generation. This persistence reflects both limited residential mobility and the durability of neighborhood conditions. Even when individual families move, neighborhood characteristics change slowly, preserving disadvantage. Historical investments and disinvestments in neighborhoods create path dependence, whereby initial conditions shape long-term trajectories. Mass incarceration affects economic outcomes through multiple pathways. The United States incarcerates approximately 2 million people, with incarceration rates many times higher than comparable countries. Incarceration rates are dramatically elevated for Black and Hispanic men, particularly those with limited education. A substantial fraction of Black men experience incarceration at some point, creating widespread effects on communities. Incarceration interrupts employment, erodes job skills, and creates gaps in work history. Criminal records create legal barriers to employment in many occupations and informal discrimination by employers reluctant to hire individuals with criminal histories. Collateral consequences of incarceration extend beyond direct participants. Children of incarcerated parents experience emotional trauma, economic hardship, and reduced parental involvement. Communities with high incarceration rates face social disruption, weakened institutions, and political disenfranchisement. The economic costs include not only foregone earnings during incarceration, but also reduced lifetime earnings due to stigma and skill erosion. Economist Becky Pettit documented that incarceration conceals unemployment by removing individuals from labor force statistics, making official unemployment rates understate true joblessness among disadvantaged populations. Political power shapes economic outcomes through influence over policy, resource allocation, and institutional design. Wealth concentration translates into political influence through campaign contributions, lobbying expenditures, and media ownership. Affluent individuals and corporations influence tax policy, regulatory frameworks, social spending, and labor law in ways that often preserve advantages. Voter suppression, through registration barriers, identification requirements, and polling place closures, disproportionately affects low-income and minority populations, reducing their political voice. Geographic malapportionment and gerrymandering distort representation, enabling minorities of voters to control legislative majorities. The political economy perspective, advanced by economists including Daron Acemoglu and James Robinson, emphasizes that economic institutions reflect political power distributions. Groups controlling political institutions design economic rules to serve their interests. Historical power asymmetries created property rights distributions, labor regulations, and tax structures that advantage certain groups. Contemporary power enables preservation and extension of these advantages through policy influence. This perspective suggests that economic inequality and political inequality reinforce each other, making reform difficult when those who benefit from existing arrangements control decision-making processes. Social capital refers to networks, norms, and trust that facilitate cooperation and collective action. Sociologist Robert Putnam distinguished between bonding social capital, which connects similar individuals within groups, and bridging social capital, which spans diverse groups. Bonding capital provides emotional support and mutual assistance, but may not connect to opportunity-rich environments. Bridging capital transmits information about opportunities, provides access to diverse resources, and enables upward mobility. Advantaged individuals typically possess both forms, while disadvantaged individuals may have strong bonding capital within their communities but limited bridging capital, connecting to mainstream institutions and opportunities. Network effects in employment mean that many jobs are filled through referrals and personal connections rather than open applications. Individuals embedded in professional networks learn about openings before public posting, receive recommendations that overcome employer uncertainty, and access insider information about organizational culture and requirements. Those lacking such networks rely on formal application processes facing greater competition and less information. Network advantages accumulate because employment in mainstream firms builds additional connections, while exclusion from such employment prevents network development. Trust in institutions varies systematically by race and socioeconomic status. Historical mistreatment, including slavery, Jim Crow segregation, predatory lending, and discriminatory policing, creates justified skepticism toward government, financial institutions, and healthcare systems among minority populations. Lower institutional trust reduces willingness to engage with systems even when participation would be beneficial, affecting use of banking services, healthcare, social programs, and legal systems. Rebuilding trust requires not only ending discriminatory practices, but also acknowledging historical harms and demonstrating sustained commitment to equitable treatment. Historical persistence describes how past injustices affect contemporary outcomes through multiple transmission mechanisms. Economist Trayvon Logan documented how slavery's legacy affects current wealth gaps, as enslaved populations were prohibited from accumulating property and building human capital. Post-slavery discrimination through sharecropping, convict leasing, and exclusion from New Deal programs prevented wealth accumulation. The GI Bill, which financed home ownership and education for millions after World War II, was implemented in discriminatory ways that largely excluded black veterans. Redlining by government mortgage programs from the 1930s through 1960s denied mortgage access to minority neighborhoods, preventing home ownership and wealth building. These historical exclusions created cumulative disadvantages that persist. Families that could not purchase homes missed decades of appreciation that built wealth for white families. Exclusion from quality education limited human capital development. Discrimination in employment and business access reduced earning capacity and entrepreneurial opportunities. Children born to families disadvantaged by these policies inherited reduced wealth and educational investments, transmitting disadvantage across generations even after explicit discrimination ended. Economist William Darity Jr. developed stratification economics, emphasizing group-based inequality and the need to address historical harms through reparative policies. Discrimination in credit markets has been documented through multiple methods. Analysis of Home Mortgage Disclosure Act. Data shows that minority applicants face higher denial rates and less favorable interest rates than white applicants with similar incomes and credit scores. Some gaps reflect differences in wealth, credit history, and property characteristics, but substantial disparities remain after accounting for observable factors. Subprime lending disproportionately targeted minority neighborhoods during the housing boom, with lenders steering qualified minority borrowers toward high-cost products while offering prime mortgages to white borrowers with similar or weaker qualifications. The racial wealth gap far exceeds the income gap, with median black household wealth approximately 1/10 of white household wealth. This disparity reflects historical exclusion from wealth-building opportunities, ongoing discrimination in housing and credit markets, differential returns on education and assets across racial groups, and unequal intergenerational transfers. Closing wealth gaps would require either extraordinary individual accumulation over multiple generations or direct wealth transfers, addressing historical and contemporary discrimination. Without such interventions, wealth gaps perpetuate through mechanisms including differential investment in children's education, unequal access to home ownership, and disparate exposure to economic shocks. Intersectionality, a framework developed by legal scholar Kimberlé Crenshaw, recognizes that individuals hold multiple social identities that interact to shape experiences of advantage and disadvantage. A black woman faces not simply the sum of race and gender discrimination, but distinct forms of bias specific to the intersection of these identities. Policies or analyses that consider race or gender in isolation may miss how combined identities create unique barriers. Low-income black women, for example, face compounded disadvantages in labour markets, housing access, and healthcare that cannot be fully understood by examining race, gender, or class separately. Economic analysis increasingly recognises intersectional dynamics. Labour market outcomes vary not only by race and gender individually, but also by their interaction, with black women facing different wage gaps and employment barriers than white women or black men. Criminal justice involvement, poverty rates, and health disparities exhibit intersectional patterns that simple additive models do not capture. Policy interventions must consider how multiple axes of stratification combine to affect specific populations rather than assuming universal effects across diverse groups. Institutional quality affects economic outcomes through enforcement of property rights, contract adjudication, regulation of markets, and provision of public goods. Weak institutions enable corruption, fraud, and exploitation that harm vulnerable populations, lacking resources to protect their interests. Strong institutions provide predictable rules, impartial enforcement, and accessible remedies for grievances. However, institutional quality varies across neighbourhoods and populations within countries. Poor and minority communities often experience less responsive government services, less effective policing, inferior infrastructure, and more burdensome regulations than affluent communities. The criminal justice system demonstrates stratified institutional quality. Affluent defendants access private attorneys, bail quickly, and receive favourable plea bargains or case dismissals. Poor defendants rely on overworked public defenders, remain incarcerated pre-trial due to inability to pay bail, and face pressure to plead guilty to avoid lengthy pre-trial detention even when innocent. These disparities produce different outcomes for similar offences depending on defendant resources. The system extracts fines and fees that constitute substantial burdens for poor defendants but trivial costs for wealthy defendants, creating effective wealth-based penalties. Concentrated poverty describes neighbourhoods where large fractions of residents live below poverty lines. Concentration amplifies disadvantage through peer effects, institutional weakness, and reduced resources. High poverty neighbourhoods struggle to maintain quality schools, attract businesses, or provide services. Social capital becomes depleted as capable individuals exit when possible, leaving remaining residents with reduced networks and support systems. Concentration creates environments where poverty appears normal and alternatives seem unrealistic, shaping aspirations and perceived opportunities. Sociologist William Julius Wilson analysed concentrated urban poverty, documenting how deindustrialization, middle-class flight, and policy changes created high-poverty neighbourhoods characterised by joblessness, family instability, and social isolation. These neighbourhoods lack not only economic resources but also institutional connections, role models, and pathways to mainstream opportunity. Addressing concentrated poverty requires place-based interventions, including economic development, housing investment, and institutional strengthening, alongside individual-focused assistance. Structural explanations for poverty do not deny individual agency or responsibility, but recognise that choices occur within contexts that constrain possibilities. Rational individuals facing discrimination, residential segregation, inadequate schools, and limited employment opportunities may make decisions that appear suboptimal from outside but represent best available options given circumstances. Blaming individuals for poverty without addressing structural barriers attributes to personal failing what results from social organisation. Conversely, addressing structural barriers does not guarantee individual success but expands the opportunity set within which effort and ability can be rewarded. Debates about structural versus individual explanations often reflect ideological commitments more than empirical evidence. Both individual characteristics and structural conditions affect outcomes, with relative importance varying across contexts. Some individuals overcome substantial structural barriers through exceptional effort, ability, or luck, but focusing on exceptional cases obscures the systematic patterns whereby disadvantage concentrates among particular groups facing specific structural obstacles. Policy implications differ depending on whether poverty is attributed primarily to individual deficiencies requiring behavioral change or to structural barriers requiring institutional reform. Research demonstrates that poverty emerges from interactions among labour market conditions, credit access, educational quality, neighbourhood environments, health systems, government policies, behavioural constraints, and discriminatory practices, operating simultaneously across multiple domains to create and perpetuate economic stratification.